Hello guys, and welcome back to another video. In this video we're going to continue our series on Market Structure Masterclass. So in this video we're going to talk about the higher time frames protocol, and before you continue, please make sure to check out ICT Market Structure Essentials so you don't get lost. So we're going to start off with identifying higher time frame levels. Let's look at liquidity pools. Okay, so there's three higher time frame levels that you should be focusing on. There's order blocks, liquidity pools, and fair value gaps. So first of all, we're going to talk about liquidity pools. Now, when it comes to liquidity pools, a lot of traders make the mistake of falling victim to liquidity purges. Okay, so what a liquidity purge is, you have a high, a purge above that high, and then the market trades lower. Okay, so this would be considered the purge. Okay, the purge is just the raid on liquidity, sweeping the liquidity like we have here. Okay, this move right here would be purging the liquidity. The problem though is a lot of traders misinterpret liquidity purges as a break of market structure. So what that is there's a high, low, high, high. Okay, now the problem a lot of novice traders make is they see that high as a break in market structure. So MSB, BOS, whatever they call it, a break of market structure. Okay, so what they then do is they start having limit orders here in a discounted market compared to this low to this high. This would be considered discount. They have their buys set there, and they're expecting price to do something like this: trade into the discount and then create another high. But what instead happens is something like this. Price completely disrespects their level and just comes with this low. Okay, which makes this move right here the purge, and they fall victim to it. They fall victim to this very impulsive move here because they thought it was a high, and MSB, but in reality it's just a purge. Okay, and the market will reverse in the other direction. So something a little like this: you have a high here and a high. Price closes cleanly above these highs, and people would consider that as a market structure break with a clean candle close. So they start looking for buys and an order block, but that order block doesn't hold and just completely reverses in their faces. Okay, so let's talk about the victims of the liquidity purge. Okay, and we need to understand the victims of the liquidity purge, because once we can put ourselves in their position and understand, okay, if they bought that breakout, or if they try to buy the dip, their stop would be right here. And as a market maker, you want to be thinking like one. Okay, you want to be thinking, okay, where are the victims' stop losses and how can I target it? And this is the first step. It's understanding liquidity purges. So victim one is your typical retail trader that buys, uses retail patterns like bull flags or head and shoulder breaks or whatever. I don't really know anything about patterns, but what they do is they just buy the breakout. Okay, and when you're buying the breakout, you're buying the most expensive prices. Okay, so let me explain this. So if we have a trading range, something like this, and then this would be your range high, and this would be your range low, and then this would be equilibrium. In this range, above equilibrium is the premium prices, below equilibrium is discounted prices, okay? But once price starts breaching above into premium, and it doesn't stop, it goes for the high here, that's what we consider very extreme prices, okay? Because that's where retail traders start buying, okay, at a premium price because they're chasing it now, okay? So be aware of when this is happening, especially if the higher time frame says we have to go down, okay? In a bearish trend, you should see price trading above old highs as a potential resistance level, right? So if the order block here doesn't hold, if the gap here doesn't hold, then you see the liquidity pool above it to be the most extreme level in terms of resistance, okay? So just like how a fair value gap can be a resistance level, a order block can be a resistance level, the most extreme prices here can also be a resistance level. So we should also view it as one. So here, this can be considered as a resistance level when we trade above it, okay? And it's considered the most extreme resistance level. People that are more informed, however, they trade order blocks, they trade fair value gaps. Sometimes, if you don't check the higher time frame, and price is in a premium here, and you're looking for fair value gaps to buy or order blocks to buy, within this area, you're looking for order blocks to buy, fair value gaps to buy, they're not going to hold, okay? Because this is the most extreme premium. As soon as we break a high, it's the most extreme premium, and bullish levels don't blend well with premium conditions, okay? So that's victim one. They'll be buying here, and then sometimes they buy here. This might be you. They buy here, and then price just reverses on them, and then they don't want to accept they're wrong, so they start moving their stop losses down and down and down and down to this low here, and then they think, oh, it's never going to reach that point, so I'm just going to move it there. But in reality, they've fallen victim to the purge. So that's victim one, okay? If they're not willing to take a stop out after price reverses on them like this, and they drag their stop loss to another low, they're going to get punished for that as well. So if that's you, now you're aware to say, okay, if I get stopped out, then just take the stop out, okay? Move on. Victim two is the person that buys the retracement. So they understand, okay, I shouldn't chase price. Let's do it here. They understand that I shouldn't chase price when it creates that higher high. I should wait for it to pull back within the range into discount market and then buy for higher low. But we understand that if this high becomes the parent order flow, because this is a high time frame resistance level actually, opposing levels such as this order block or this fair value gap here or this low are going to be seeked. Okay, so remember the previous video I just made, where we had a daily level, a daily liquidity level, hits it, and then trades in the other direction. It's because this level acts as the parent order flow, and then anything against the parent order flow starts breaking. So this order block breaks, this order block breaks, this fair value gap breaks, and then that's your draw on liquidity. these lows here. So although buying retracements is what you want to do, it must align with parent order flow. So instead of buying this retracement here at this order block for a high low and expecting a high high, what you should have done is sold this retracement for a lower low. You see, this one plays out because it's trading with the parent order flow, which is a run on highs. That's a purge of liquidity, and then that's your short setup there. So now that we understand the two victims, okay, their stops would be the draw on liquidity, okay? So this move right here is a purge, okay? We have an old low here. People will be selling at a discount, FOMOing, they'll be selling, but to the interbank trader, we say that's extremely cheap because price is traded below an old low, okay? Now that would act as parent order flow, okay? Where are the people that sold this move going to place their stop loss? Well, you start looking to the left, here, or even here, okay? Or it could be someone who's more aware. They understand that I should sell a retracement instead of chasing on the breakout here. So what they do is they look for here range high, range low, and this is premium market, so they sell. Oh, that's an order block right there, so they sell there. But like I said, if you're trading against the parent order flow, your level is just going to break, okay? So the person that sells there, order block and a fair value gap, that's a very high probability pattern, but if it's against the parent order flow, it's supposed to break. The person that sells that order block, however, where they're going to place their stop, they're going to place it here. So that's why we view this entire leg as the inducement liquidity. Okay, so the purge happens here. This induces shorts in the market. How does it induce shorts in the market? People selling on the breakout, 1. People selling on a lower high, 2. Where is their stop loss going to collectively pull? Right here. So that entire move just generated a ton of liquidity above this high, hence the name inducement. Okay, hopefully that makes sense. Same thing here. This is the liquidity purge here. How does this move induce liquidity? People buying at a breakout here, 1, or people buying at a dip, 2. So 1 and 2, where they're going to place their stop, where's the most logical area? Their stop's going to pull here, especially the people that thought this is a double bottom as well. So always look to the left, and you can see sometimes it's forming even more liquidity. Okay? And sometimes liquidity purges can happen on a very big scale. Okay? So here, breaks clean highs, where they're going to place their stops inside the range, or even here. So if you checked out Bloomberg at the time, Bloomberg, the very worldwide news channel, everyone and their mom was telling that's the low for the S&P market, and they might have bought the S&P 500 right there and they want to hold for 5-10 years because they see it as an investment. Okay, so they feel like their stop loss is clean here and it's nice. It's never going to see that area again, and they actually might buy some more at the breakout there because that's how a retail trader trades. Understand that although this might look like a big area of time, some people are really playing for the bigger picture. They're playing for 5-10 years ahead of the game and not just day trading. So what liquidity pools to focus on? Okay, we're talking about extreme prices here. And extreme prices are when price breaks out of a trading range. Okay? Here, that's the most extreme prices. And the first liquidity pools that we want to focus on are previous month highs and previous month's lows. And a little tip for you guys, when it comes to liquidity pools on the daily chart, you want to make sure that liquidity pools that you're using have space and time between them. So what do I mean? If you look at this purge right here, you want to make sure that this area right here, we have space and time, tells us that there's time for for liquidity to accumulate above this high. Okay. Also, previous month's highs and previous month's lows offered a really big reaction afterwards. So you can see here, low of September, reaction happens afterwards. It's because these liquidity pools are higher time frame liquidity pools. Okay. High of November here, high of February. We also want to focus on previous week's highs and previous week's lows. So previous week's highs can also be used a very similar way. Okay. So previous week's highs and lows are support and resistance levels. Here, previous day's low, which we'll talk about next. But previous day's lows and highs, we're going to talk on an intraday basis. So when it comes to the higher time frames, please just focus on the month's highs, month's lows, week's highs, and week's lows. You can also use liquidity pools when focusing on internal range liquidity. Okay, so internal range liquidity is when price has a trading range like this, and we're seeking a discount market, for instance. This is when price seeks internal range liquidity rather than external range liquidity. Okay, so what I mean by this is we have a trading range here. We can use liquidity pools inside of the trading range. Okay, so if this is low and high, if we have a swing low inside of that trading range, that would act as a liquidity pool. So price would seek that to trade higher. Now what you want to do with internal range liquidity pools is you want to blend them with something. Okay, so what I like to blend them with is 1, an order block, or 2, a fair value gap. So we can see here, if we did that very thing, we have a previous week's low, and we look to the left, where could price trade into also? Well, we have a down candle here. We'll use the mean threshold of that. So that's an order block plus internal range liquidity in form of previous week's low. Okay. Same thing here. We have this entire leg here. So this entire move down here. Inside of that range, we have clean highs. So that clean high can act as a liquidity pool inside a premium market. So this entire area is premium from this high to this low. We can use liquidity pools inside of that range as a resistance level here. Okay. Same thing here. We have this high to this low. Inside a premium, we have a swing high there. And like I just mentioned with the order blocks, you can blend an old high with an order block here. And you can see, actually, fair value gap, my bad. And you can see how price takes our liquidity pool into a fair value gap. Okay, same thing here. We have a range, trading range. Price can take out a short-term high into a premium market and then have a sell-off. When it comes to internal range liquidities, okay, focus on previous week's highs and previous week's lows, and previous days highs and previous days lows. So previous days highs, previous week's lows. Okay, these ones don't really have as much space and time. If you remember what I just said, this has a big amount of space and time, so that gives a lot of time for liquidity to be building above these highs. But when it comes to previous week's highs and lows, or previous days highs and lows, you can see the space and time is not as significant. So it's a very short-term hunt. So when a liquidity purge happens, how do we confirm, okay, that's actually a liquidity purge? Okay, and there's two ways. One will be an aggressive approach, and the other will be a conservative approach. Okay, so it depends on what style of trading you like, right? What trader are you? What type of trader are you? Are you an aggressive trader, or are you a conservative trader? Okay, an aggressive trader might have more trades, yes, but the win rate of those trades might be significantly less when compared to someone that's more risk adverse and conservative. So an aggressive confirmation is as soon as price takes out a low, like this, you can start looking for an order block without the break in market structure. Okay, so here we have low to order block. There was no break in market structure here, actually a short-term high, but the point is aggressive is going for the purge straight to an order block, or purge straight to a fair value gap, right? Like this one here, purge straight to the order block. Bearish example is we have a purge here, and then we went straight into a fair value gap here with an order block. Okay, I labeled that one wrong. Here we have a purge above the highs. If we see a gap print, we can take the fair value gap as an entry, and a conservative person would wait for that to break. But an aggressive person, if they see a purge and then a fair value gap, they take that fair value gap right away. So this is a conservative approach. It's where they have the purge, to a market structure break. So they're waiting for highs here, and then they're waiting for that structure to break, or this one as well. Sometimes when it comes to purge to market structure break, you might have to adjust the time frames. So you might have to shift down a time frame for more definition. And again, this is when you have to be flexible. Okay. So here, for instance, was this low right here, but we don't see a high we can consider as a market structure break here. Right, there's no highs here we can consider. So this is when we shift down a time frame into the 4 hour for more definition, and that's what I did here. I shifted down, and then you can see since we went down a time frame, we can see more swing highs and more swing lows. So when price did take out that low, we can see, okay, that's a clean market structure break. And then you'll be waiting for an entire retracement. Okay, so real quick, I'm going to compare the aggressive to conservative here. So conservative, you're waiting for that market structure break, and then you're waiting for that full-on retracement, right? But the aggressive trader doesn't have to wait for that full-on retracement. As soon as the liquidity purge happens here, they can use a order block to enter on, which you can see here. Okay, so They need a clean break above an order block. Why not this one? Well, there was no engulfing green candle here. Okay, so that one didn't work. But in this one, we can see this candle gets engulfed by this bullish candle here. And think of it like as an instant retest. Okay, so there's a rounded retest, and then there's an instant retest for a pop higher. So this one's aggressive, this one's conservative, waiting for the market structure break. Here's an example of a conservative. They're waiting for the low to break, and then the rounded retest. Okay, so low to break, and then the rounded retest. But the aggressive trader would say, okay, that's the purge in liquidity. I'm looking for an engulfing candle to happen, which is a bearish order block. And you can see this is the last up candle here. They could sell into that and not wait for the market structure break. So let's talk about order blocks now. So we just covered liquidity pools, and there's a reason I discussed liquidity pools first. Okay, the very reason I did is that liquidity pools often follow market reversals. Market reversals are highs and lows the market does not want to revisit, therefore forming a long-term high or low. So if we take a look at this, liquidity pools often form a long-term high or low, and it takes a while for this to get revisited here. Just look at the dates there. Okay, so liquidity pools often form long-term highs and long-term lows. Same thing here. Same thing here. And check how it goes from bullish to bearish. Okay, so bullish to bearish. From bearish to bullish. It's a reversal. Okay, reversing from bullish to bearish, from bearish to bullish. So let's talk a little bit more about long-term highs and lows. Okay, once we know a long-term high or long-term low is in, we can expect institutional order flow on that long-term perspective to hold. This makes choosing order blocks very easy. So here we have the first long-term low in. We have long-term low in. Now we can start saying, okay, this order block's going to hold, this order block's going to hold, this order block's going to hold, and these order blocks are going to hold. Okay, and we'll talk about these order blocks in a bit. Okay, but take a look at institutional order flow. Resistance levels start to break. Order blocks, bearish order blocks start to break. Bearish order blocks start to break. Bearish order blocks start to break. Okay, so now this puts perspective. Once a long-term low is in, we can expect these opposing order blocks to break, and these opposing highs to be hunted. Okay. Let's talk about a little bit more about bullish institutional order flow on the daily chart. Okay, so on the daily chart, once we have that long-term low in here, we start looking for bullish institutional order flow. What bullish institutional order flow is that on the daily chart, every down candle will be used for new buying opportunities. So you can see here, down candle here, down candle here, down candle here, down candle here. Now pay attention to this part. After that down candle forms, we can expect displacement. Displacement on the daily chart leads to multiple days of bullish candles. So we can see 1, 2, 3 bullish candles here, displacement, bullish candles here, displacement here, displacement here. So whenever we have down candles, what precedes that is displacement. displacement. And we can expect this to happen when the long-term low is in. And this is all just institutional order flow on the daily chart. And if we look to the left, resistance levels, they're going to break. They're all going to break since bullish institutional order flow is the key here. Now let's talk a little bit about bullish order block probabilities. Okay, so the closer we get to the draw on liquidity, the less likely an order block is going to hold. Okay, let's explain this. So here you can see that if price comes and tests the order block, they're going to hold. Because if we look to the left here, price is in a discount and we've just taken out a old low and we're extremely in a discount here. Okay, even if we got the range high here to range low here, this would be a discount. But the more we start trading higher and higher and higher to potential resistance level, price starts to be in a premium market. And if we blend key levels or an order block in a premium market, they're not going to be expected to hold. Okay, so if we look here, this is where a high forms. Okay, this order block here, since it's in the premium to the left here, when price comes to test it, it doesn't hold. What about this one? When price comes to test it, does it hold? No, because we're still in the premium. But once we get down to fair market value, which is equilibrium, levels can start to hold again if it's bullish, and that's why you see this fair value gap here hold. Okay, so now we're back in bullish conditions. So what we can do now is, okay, once the market has traded back to a discounted market here, we can resume, the order blocks can resume to hold again. So here we've traded into a discount now. Then if an order block prints, a bullish order block prints, they're going to hold as usual. Okay, now with bullish institutional order flow, what happens afterwards? Down candles produce displacement in price. So now let's talk about bearish institutional order flow. Okay, so on the daily chart, every up candle will be used for new selling opportunities. After that up candle forms, we can expect displacement. Displacement on the daily chart leads to multiple days of bearish candles. Okay, now why is this very key for us day traders? Well, this is key because we're not looking for opportunities to enter on the daily chart, but we're looking for opportunities. So once we have an opportunity where we say multiple days are going to be bearish, that means whenever we go intraday on an intermediate term perspective or a short term perspective, all we have to do is wait for price to trade above that high, and then we're looking for our sell entry, and then we're going to wait for the daily candle close, and we're going to wait for that range expansion for our profits. Okay, but this is the easiest part here once we understand what's going on in the long-term perspective. So if we understand that up candles produce displacement in price, every time displacement is happening, this is our bias. Okay, multiple days of being a bearish seller. But let's not forget, bearish institutional order flow is going to happen when a long-term high is in. Okay, so we have a liquidity pool raid here, creates a long-term high, a reversal, and then the move that comes next is bearish institutional order flow. So every up candle will produce selling opportunities. Up candles here, selling opportunities. Okay. So now let's talk about the bearish order block probabilities. So the more we trade into discounted prices, the less likely bearish order blocks are going to hold, right? Because discounted conditions don't blend well with resistance levels. Resistance levels blend well with premium prices. It's because discount is basically oversold and this is overbought. So just think of this like as an indicator. So the closer we get to a draw on liquidity, the less likely the order block's going to hold. Okay, this is when it takes out low, that's extremely discounted, remember. So we're going to have to wait for price to trade back into a premium. So price, what's the trading range? Well, here to here, that's one. This is a premium. So you might be wondering, okay, where's the order block? Well, that's an order block there. Okay, and this is a breaker. So breaker is an order block that formed the purge. Okay, so here is an order block breaker inside a premium market. Since we're in a premium market, that would act as resistance. Okay, and then after, okay, we traded back into a premium now. Check out bearish order blocks again. Up candle here, displacement to the downside. Up candle here, displacement to the downside. Okay, so that's how you use bearish order blocks on the daily chart. So, order block confirmation. There's two ways we can use an order block. One would be an aggressive approach, the other would be a conservative approach. Similar to liquidity pools. So this is the conservative approach. Okay? The conservative approach will wait for retracement. And retracements occur at opposing liquidity pools. And if the retracement happens, it will trade back into a deep discount or premium. So let's explain this. So here, we're expecting an order block to form because this is bullish institutional order flow right here with the long-term low here. So we're expecting all down candles to hold as support. The conservative way of trading an order block is waiting for price to take out an opposing liquidity pool, because that will offer retracement. And then we're looking for a retracement into the last down candle in a discounted price. Okay, here's another example. Price trades back to fair market value, remember, and order blocks will start to resume again. So what we can do is, as soon as this order block prints, we're waiting for the retracement to happen after an opposing liquidity pool gets taken out. Retracements occur at opposing liquidity pools. Then we could wait for price to trade back into the discounted market here. And then we can take action with the displacement there. Okay. This goes the same. So this is a breaker. Low, high, high, low, low. Breakers' intents are to take out liquidity pools. Okay, so let's not forget about that. You can see this low gets taken out. Opposing liquidity pools will offer deep retracements. And in this case, since we're expecting bearish institutional order flow from this high, where is the deep retracement going to occur into? Where we have this high to this low. Are we looking for this order block? No. Are we looking for this gap? Yes, we could use this gap. But you might have had to take a loss there. Doesn't matter. What's the next level? Breaker. Bam. Now, we can start resuming with bearish order blocks. but since we're focusing on the conservative approach here, we have a order block being printed here. So what we're going to do is wait for a swing low to offer retracement. So opposing liquidity pool here will offer retracement into that order block. So that's the conservative approach. Waiting for a swing low to offer that retracement into the last up candle. So here is the aggressive approach. So the aggressive approach just waits for a close. Okay, so closes occur every 24 hours and they don't require a deep discount. So an example is this. Since we know that this is bullish institutional order flow because of the long-term low here, this one will be conservative, waiting for that deep retracement. But an aggressive approach doesn't have to. The aggressive approach just waits for the candle close for the quick instant retest before the displacement. Okay? Here again. This down candle here gets closed above, instant retest, takes out a high. Okay? This one as well. This up candle here, close below, aggressive entry, displacement. Into where? A fair value gap. Then we know, okay, that's going to send prices bullish again. Conservative here is waiting for price to offer retracement into this order block here. But this one is an aggressive one. You're just waiting for the close. So you can see the close happens. Then it quickly taps into this high here for displacement. So that's the aggressive approach. Some bearish examples of an aggressive approach. You have the long-term high here. So parent order flow is bearish here. We can look for institutional order flow to be bearish, which is this. Now, bearish institutional order flow, we're going to focus on order blocks and imbalances. So, imbalance there. But since we're focusing only on order blocks here, we can see that these up candles gets closed here. That's your aggressive approach. There's no need to wait for a retracement. Okay, no need for deep retracement. As soon as the candle, for instance here, closes below the order block, you can see how this just quickly taps into this low here, then has a displacement. Same thing here. Up candle gets closed below. Up candle gets closed below here. Quickly retests that level, then displacement. Down candle, close above. Quickly test that order block for displacement. So you can see that this approach does not require an opposing liquidity pool for a deep retracement like this. You can see this is a deep retracement. As opposed to this, it's very instant. Here's a clean one. Liquidity pool. Up candle gets closed below. Retest displacement. So now let's talk about fair value gaps. And there's also a reason why I discuss fair value gaps last. Okay? And fair value gaps will be used as a probability enhancer. So what that means is, if you see an order block and a fair value gap, that order block turns into a high probability order block. Now, picture that in with parent order flow and institutional sponsorship. If you see an order block with a fair value gap, that is a key level. So here, long-term high forms. Last big beefy candle here, that's your order block. Pair that with fair value gap, becomes A plus order block. So you can see the fair value gap enhances the order block to make a high probability order block. Okay, and now since we're focusing on bearish institutional order flow here, we're focusing on up candles to create new selling opportunities. So you can see here, up candles forms an order block here. Since this order block has a fair value gap with it, that's a high probability order block. So you can look for sells there. Selling opportunities will occur at these levels. 1, 2, 3, 4. That's 4 days of being a bearish seller. Okay. Price takes out a recent low, offers a retracement into this order block. Look what's inside that order block. We have a fair value gap here. That's a high probability order block. Okay. Same thing here. This is the more aggressive order block. You can see up candle with a volume imbalance. A volume imbalance is essentially a fair value gap, but you can just see it instead. So pair this order block with that gap. That's a high probability order block, and you can see that we did have a nice selling day before taking out this low. Up candle with a fair value gap, high probability order block. This the same. But you could also use fair value gap as a key level itself. Okay, so you don't need to focus on the order blocks. Okay, you can just say I'm only going to focus on the fair value gaps. That's it. You don't have to say, to be consistently profitable, you don't even need to know all about order blocks. Fair value gaps is really enough. If you can identify fair value gaps as key levels, then you could already be profitable. You don't need to understand order blocks in depth. So here, price takes out a high, key long-term high prints. Now we know that bearish institutional order flow is going to take place, so resistance level is going to hold. Here is the first resistance level in the form of a fair value gap. Hits that. Since we know that up candles form new selling days, we have displacement to the downside thanks to institutional sponsorship. So every single one of these days here, you have a bearish bias. Same here. With bearish institutional sponsorship and a bearish key level, once we hit that, your bias becomes bearish now. Okay. Targeting a short-term draw on liquidity. So let's talk about when anticipation becomes confirmation. Now, what I mean by this is you have a key level here, and you're anticipating a sell-off here. But when does that actually get confirmed? So let's talk about that. Hello everyone, welcome back to Market Structure Masterclass. We're going to continue our discussion on the higher time frames protocol, but this time we're going to focus on when anticipation becomes confirmation. So I want to talk about a few mindsets we must have when we're specifically looking at confirmation. A lot of people, when they have these higher time frame levels, they just execute blindly on that higher time frame level without any confirmation. But that's the wrong thing to do. What we want to do is we want to anticipate that higher time frame level is going to hold and act as resistance or support. Then we're going to jump into the intermediate time frames and look for confirmation. So anticipation is expecting something to happen. Confirmation is finding supporting statements by evidence, and that's done with market structure breaks and displacements. So if you're just entering a setup based on anticipation only, you're gambling. But if you're anticipating a level to hold, then you see confirmation of that level holding, that is a solid setup. Our setups are plentiful and repeat frequently. What you can do is you can go back into TradingView and look at the charts all the way back from the 70s and the 80s. You'll see that these setups are actually panning out the exact same as they are today. Well, it's just a lot more efficient today since it's algorithmic, it's AI based, and back then it was actually human beings. But it's just shifted into doing things more efficiently, which is even better today. That means this is going to be so much more plentiful and setups that repeat frequently. So you should never have these feelings of FOMO or fear of missing out. Always wait for that confirmation on that level you anticipate trading on. We do not execute before there is evidence in price. We know, understand, and trust prices, characteristics, and repeating phenomenon. Nothing we do is a guess. And if you're still struggling with this point, don't worry. There's still some development process you need to go through, and what you need to do is just every single day journal the daily range. Journal the daily range. Okay, so after you go through the Structure Masterclass and you have a framework to view price on, depending on what style of trader you are, then the real work is actually when you're going into your journals and you're marking up these charts and saving them over and over and over again. And through time, you can't rush this, but through time, you'll understand that these setups are actually plentiful and they repeat frequently. So let's talk about using our level from the long-term perspective. So this is just to quickly sum up what we've learned from the previous two videos. Okay, so this is just a quick step-by-step approach on, alright, finding the level. Okay, and then once we found the level, we can then jump into the lower time frames and look for that confirmation. But this is how you anticipate things. So the steps of anticipation are as follows. Before we can anticipate reversal at levels, we must conclude that our trading level is one of high probability. And what I mean by probability is that there's a high chance of it holding, and I'll walk you through all the steps here on what makes a high probability level again. Well, once we have that high probability trading level, from that level we can anticipate that it's going to act as parent order flow for future moves to come. So right now, I'm looking at this daily chart, and I see that there's clean highs here, okay, and I see that we've retraced in the premium, and I see that there's a breaker, okay, but that's because I have a little bit more experience. But let's just say that, you know, this chart's very unclear for me at the time. What can I do? Well, I can shift up a time frame, and I'll use the weekly chart as my long-term perspective. You can see the daily chart is here, marked D. So now we're on the weekly chart, and we can see that, okay, it's very smooth price action. It candle close every 5 days, but I can clearly see what I'm looking at right now. Okay, this gives me a better view on what levels to use, and we'll just work our way down from this point on. So when we have that long-term perspective, we just want to look at, okay, what has happened already? Okay, what is the weekly chart telling us? What has happened previously? Did any liquidity pools get taken out? Did we break any market structures? Did we have displacement when we broke that market structure? Are we retracing? Are we expanding? What's going on? What's the story behind it? So let me just walk you through this story right here. So first we have a high of November that gets taken out and pierced through. Okay. Already we don't want to be a buyer there because that's extreme prices, right? We don't want to be a buyer when there's a breakout happening. Okay. So understand that this is a very high time frame level because space and time here, space and time, and it's a monthly high. So the next candle after piercing that high of November, we see a quick rejection lower. Now for the aggressive trader, that is a order block setup here. So you can see order block here with the AGG, that's just short for aggressive. An aggressive order block trader can just wait for the high to get pierced and just enter on the order block. Okay. Where's he targeting? Okay, clean lows. Let's clean lows here. Okay, so we displaced down there, and check out what happened. We left a displacement. Okay, we left it very nice and balanced, and that just shows that, okay, that the high of November was actually used as something significant. Alright, because displacements on the monthly chart can only happen when there's banks and financial institutions involved. Like us regular traders, okay, we can't move the monthly chart like this, so there has to be like some high entity out there that's really aggressively moving this down, and that shows that's a sign by these imbalances here. Okay, but imbalances with the correct narrative. So high of number just got taken out, order block just printed an aggressive one, then we displaced lower. Okay, do you understand that there's a story behind that now? Okay, so how did we close that imbalance? Well, we just broke a recent low. We closed clean below it. Well, that's a market structure break. So right now we can see, okay, that's a potential long-term high that's into place. So we trade down lower, we trade down lower. Do we want to be a seller here? No, because that's extreme in terms of cheap prices. We don't want to be breaking out shorts right here. Okay, so this was a valid sell into this imbalance, targeting sell side liquidity. But now we have another sell side liquidity pool here that can offer potential retracement. So whenever we see liquidity pools can either offer a reversal or it can offer a retracement. Okay, retracements happened when it's counter the initial direction it wants to go. Okay, so it takes that liquidity pool and then it retraces, but it doesn't come for this high because this is not a reversal. Here is a reversal because of the signs we just marked out. High of November, aggressive order block, displacement, close below a low. Okay, that's why this was a valid short, targeting another sell side liquidity pool. Okay, so now we go to the same thing. Okay, sell side liquidity pool offers retracement. That's the story now. Okay, so where can it retrace into? Well, if this is the trading range from this high to this low, what are the conditions of the market? Okay, where can I find a premium? So if we're looking to be a seller because of what price just told us recently, we want to start looking for resistance levels. But we know that high probability resistance levels are ones that are found in a premium condition. So if we're looking at this order block here, you can see that once we have an order block in a discount and we're bearish, we can say that, okay, that's probably not going to hold. Okay, we want to be focusing on levels found inside of a premium. This is why it helps to make sure that you can shift up a time frame and shift down a time frame and be flexible. Be flexible because you might not realize that, okay, this could have a deeper retracement. Okay, after a market structure break, this can have a deeper, more rounded retest. So first of all, what's inside of this range? Well, there's an internal range liquidity pool that comes with these clean highs, and there's also the high of January. Okay, so that's already one reason that this can drop down lower. We just taken our liquidity pool. We know that this is a long-term high that caused a reversal. This liquidity pool can do the same exact thing. We're in the premium market. Prices are extreme because it just broke out of the high of January. That is a potential reversal. But let's look at some more factors because we want to make sure that our level is one of high probability. So we're looking at this range here. And where's the order blocks? Well, the order blocks are the most extreme part of the range as well, but it's just not the liquidity pool. So you always find like an imbalance, an order block, and then the liquidity pool. So we can see here, order blocks are the up candles before the downwards move inside a trading range. Okay, but if there's two consecutive order blocks, we can form that as one. So these up candles were used for selling, right? Because the moment price is breaking above this high, banks, financial institutions, they're selling into those extreme premium prices, which is what you want to do when you want to sell high and cover that position low. So it makes complete sense. So now we have a conservative order block. So we understand these are the two up candles before the downwards move. It's a rounded retest because we broke market structure. This is a conservative order block. This one right here, this up candle, downwards move, and the retest, that's an aggressive approach. But the conservative approach, as I discussed in the previous video, is one that's more of a rounded retest. So now we're just really reinforcing that high probability level. Okay, nothing's random here. Everything makes sense. There's logic, and that's why I love trading so much. There's an order block. We're in a premium condition. We're expecting a rounded retest, and there's an order block. So if there's liquidity and an order block, like I mentioned in the previous video, that's a high probability order block. So right now there's just so many factors that are screaming out that, okay, pay attention to this level right here. So after going through that weekly chart, we can shift back down to our daily chart, which might have been your intended time frame to look at for a long-term perspective. But now we have some more clarity on what to focus on. Okay, and now we can just blend the daily and weekly together, and then that's our long-term perspective. That's our higher time frame bias. That's what we're looking for. So now that we have more clarity from the weekly chart, the daily chart becomes easier to understand. The daily chart now prints an order block for an aggressive key level. Remember, liquidity pool pierced. Now that candle becomes engulfed. This is a potential order block for an aggressive entry. Right? So the conservative one is waiting for a break in market structure and then having that rounded retest. An aggressive one is when you pierce a high and then you instantly retest it. So instant and rounded. That's the two defining points between aggressive and conservative. Okay, so we have an aggressive order block being printed here. This shaded area, that's the where we're looking for as a potential aggressive key level. But before we want to hunt into the lower time frames and look for confirmation, we want to find, okay, a potential drawn liquidity, so we don't get lost. The drawn liquidity acts as that magnet for price to draw towards, and tells us, really makes institutional order flow on the lower time frames a ton more easy. But to not really get lost on the lower time frames, you need to know what you're looking at on the higher time frames. So you already know that, okay, that's going to be resistance, that's going to be the short-term target. I'm just focusing on being a bearish trader within this zone here. So when it comes to finding a draw on liquidity, you want to mark out, okay, what's the present trading range at the moment? So this is the present trading range from this low to this high. And since this is around equilibrium from this low to this high, 50%, we want to be finding our draw in a discounted market, which is around here. So what's the target that jumps out at us? Well, we have an imbalance. So that's the first one. We're not going to aim for this low yet or this low, because it doesn't have to do that. We're just going to play it step by step. Because by the time price reaches this point here, that's going to take multiple days or even weeks. So there's no need to be rushing. Okay, it's going to go here, 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 all the way to the left. Get a level from 5 years ago. You don't have to do that. Just focus on, okay, what's the present trading range here? What's the present trading range? What's the internal range liquidity target? That's going to be my first target. If it breaks, then I target this low. Now if this low breaks, then I target the next low. Just doing it step by step by step by step. So once price trades into our key level, we anticipate it to act as parent order flow for the move downwards. Okay. So when there's a green candle and we're bearish, we want to be selling into that, because we know that from the previous episode, with bearish institutional order flow, up candles like this produce downwards moves. So we want to anticipate that happening when this up candle is trading up, and we're going to expect it to create a downwards move based on all our factors we've outlined here. Okay, so once you've outlined all these factors, this part becomes a little bit more comfortable. Maybe if you're completely brand new, selling into a bullish move, especially when it's pumping, that might have been a bit uncomfortable. But now that you're viewing price from an interbank perspective, you're going to have to be comfortable doing the opposite of what a lot of people say. And that's why it's best not to be in Discords or Twitter or just looking at other people's charts, because what you're going to be doing is you're going to be considering their perspective. But this is a one-man army, a one-girl army. So you just want to be focusing on your trades only, okay? So we got that move, and you can see that every up candle provided selling opportunity. So up candles provide selling opportunities. But what happened here? So this is what you want to be aware of on the higher time frames as well, on the long-term perspective. When you're at 50% of the price range, here, 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 expect or anticipate a potential seek and destroy. Okay, so what seek and destroy is, it's basically just trapping shorts here, inducing shorts here, and creating a collective pool of liquidity here to raid, liquidity purge, for another drop down lower. So anticipate that there's going to be some sort of seek and destroy with bearish undertone. Why is it bearish undertone? Well, we've outlined that this is bearish, right? But if we're looking at liquidity pools and which way is it going to go now? Well, now you know. It's a bearish undertone, so we can be a seller above here. Okay? Because liquidity pools is a resistance level as well. And not to mention, forgot to mention, but we have a liquidity pool here, and we have an order block there as well. So if you're trapped inside a consolidation and you want to know which way is the consolidation going to break out, are we going to go leg down, pause, and another leg down? Well, it all depends on the factors that you've outlined here. Now let's talk about intermediate term perspective for confirmation. Let's talk about market structure breaks. So the secret behind market structure breaks is narrative. It's not high, high, low, high, high, low, low, low. No, that's not it. The secret behind market structure breaks is narrative. What is the reason behind the market structure break? So if you fail to understand the narrative, the reason that makes the market structure break valid, you'll fall victim to false market structure breaks. Okay, so let's say you don't have any clue about narrative, and you're just saying, okay, high, 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 low, high, 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 low, high, high, oh, low, low. That's a market structure break, isn't it? Just like the textbook. Retail trader says low, low, then lower low. That's a market structure break. I'm going to go short the lower high and expect a lower low. Right? That's what the retail trader thinks. But the interbank trader understands narrative. Why is narrative bullish? Well, parent order flow, we just reacted from a bullish level, and we have displacement on the upside, so we should stick with that bias. Okay? Even if price trades underneath a low, we don't view that as a market structure break. We say they're buying those sell stops, because that's an extreme discount. That's extremely cheap if it goes below a low, right? That's liquidity pool for them to collect. Then they understand, okay, if smart money is buying underneath the lows, okay, where is the inducement's liquidity? Will be right up here. Why? Well, basically, just to recap, there's people that shorted the breakout here, so they're going to place the stops above here. Also, there's people that are going to short this lower high here, so they're going to place this stop as up here as well. So smart money says, I'm going to target that area because we've just collected liquidity within a bullish narrative. So that's the target. And if there's a resistance opposing us, we expect it to break. Okay, so resistance level that are opposing bullish institutional order flow, they're going to break. And if you're wondering, okay, how did you find the narrative then? Like, how do you find the narrative? Well, we just did that very thing. All of this is narrative. This is the reason. So once we jump into this point right here, we can look for market structure break. And that's real narrative. We're not looking for a market structure break here. None of them. We're not looking for no bearish market structure breaks here, because we didn't hit anything significant yet. But the moment price takes out clean highs here, and we've printed an aggressive order block, alright, that's when we can start looking for a market structure break. So here are some examples of these false market structure breaks. So understand that we haven't hit a resistance level yet, so there's no reason for a market structure break. So all these people that see these, oh, lower low, I'm gonna short the resistance level for lower low. You're falling victim. This lower low is a inducement. It's to trap people. That's the intended move. Even if you follow the strategy of this taking out a high here prior to 8:30, low, the fair value gap. I'm taking that short and I'm going to target this low here. Yes, the pattern works. The pattern absolutely works, but it has to align with what you found on the daily chart. Otherwise, it's never going to work. Same thing here. 8:30. That might have been SMT. So you slow market structure break. I'm gonna short this order block here with the fair value gap, put my stop above here, and the price just reverses on you. When that happens, take the stop out, because sometimes you might be viewing the market wrong. It doesn't matter. So don't move your stop, first of all. And the next time you take a trade, try to see, okay, I took a loss, but that's a cost of business. That's price telling me more information now. So what does the daily chart look like? What does the weekly chart look like? Don't rush back into position. Just take the hit. It's like this is how you deal with losses very efficiently. When you look at like a boxer or MMA fighter and they get hit in the face, do you think they're instantly reacted to that? No, they keep their calm, they keep their cool, and they're waiting for the best high probability jabs to punch right back at them. It's the same exact thing with trading. The moment you take a stop out, don't be aggressive and jump right back in and revenge trade. Just take the hit and be non-reactive. What can you learn from the stop out? What can you improve better from it? And just move on. So here's what it's like when a stop hunt occurs, okay? So here we understand, the interbank trader understands that the narrative is bullish, and failure to understand narrative leads to false market structure breaks like this. You can capitalize on those moves with a stop hunt to order block, or stop hunt to fair value gap, right? These market structure breaks are not real market structure breaks because they didn't follow the narrative. We must frame market structure breaks from the long-term perspective. Okay, so we have a long-term perspective level here. Only then we can start looking for a market structure break for confirmation. So we're going to look for that on an intermediate term perspective. So if we hit a long-term perspective level, that's a resistance level, and then we break market structure below a low, okay, that is a valid market structure break. Okay, so let's see what a mindset of an interbank trader would seem like. Interbank trader says, I'm anticipating the narrative to switch. Why? Because we have a high time frame resistance level, a high probability one as well. A market structure break will confirm this. Low, low, low. Now, it's valid to short on the lower high for a lower low. You see? What does the retail trader think? Retail trader says, without any narrative, retail trader doesn't know there's a resistance level here. So the retail trader says, oh, we just made a high. They're looking for buyers here. Well, the more aware people say, oh, stop hunt here, market structure break here, I'm gonna buy in a discount here. So they put their longs here, and it just breaks. Okay, so narrative is the key here. So here, false market structure breaks. Why are they false? Because we didn't hit a higher time frame level yet. Now we hit a higher time frame level here. You can see here we have a low, breaks that low with displacement. Why is it displacement? There's a gap there. Okay, so once you have market structure breaks, what really helps is if you see gaps. Okay, so market structure break, gap at a weekly order block level. We're on the 60-minute time frame. That's a valid market structure break. So once you have that market structure break, that means the level has been confirmed. We then expect the long-term perspective level to act as bearish institutional order flow, so the parent order flow. Right, so if you go back to episode 1, okay, that's when we talked about parent order flow. Now we want to see bearish institutional order flow occur after the market structure break. So this entire red shaded area, okay, we're expecting displacements to the downside, aggressive moves to the downside with gaps, long range candles. We're expecting support levels on the left side to break, and we're expecting resistance levels on the right side to hold. Let's go into that right now. So market structure breaks. Now we're expecting support levels to break. So the first support level was this order block right here. Right, you can see that price breaks it. What about resistance levels? We can see here, gap, order block. That's a resistance level. It holds. Displacement. Aggressive moves to the downside. You can see these up candles are short-lived. And support levels are breaking. Alright. If we retrace, because we have a liquidity pool, alright. Where's the next resistance level? Up candles. Up candles will hold as resistance levels. Okay. You see here, that up candle provides new selling opportunities because it's bearish institutional order flow. What can we expect next? Displacements or gaps. Okay, gaps, order blocks, liquidity pools, all these levels on the bearish side of things will act as resistance levels, and these down candles here, or this fair value gap here, they expected to break because we've hit that weekly bearish order block. We've had that market structure break. We're expecting bearish institutional order flow to take place. So, just like I outlined in this one, displacement to the downside, support level was breaking, resistance level was holding. You can see all the resistance levels holding, all these support levels breaking, all because of this weekly bearish order block. Now let's talk about market structure shifts. So market structure shifts lead to an intraday draw. Okay, intraday draw can be an internal range liquidity pool. So from this high to this low, it could be an internal range liquidity pool or a fair value gap. But market structure shifts, the main point is it can act as that retracement to this level before we have another leg of selling off. But the market structure break is when this entire trend is going to shift to the downside. Okay, so let me repeat that. Market structure shifts are these little swings here, 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 here. There's going to be MS shift here. There's going to be NMF shift here. Alright? But market structure break is when you have that big swing to change. So whatever happened here, this is bullish institutional order flow. Once you have a market structure break, this becomes bearish institutional order flow now. Okay? So, an example is we have that weekly bearish order block. We have a previous day's low that can offer a retracement. What's the intraday draw on liquidity? Well, this aggressive order block here. Okay, so we're just going to say that's a little intraday draw on liquidity before we see another round of selling off. Why is it intraday? Well, for price to come into this level, how many candles do you think that's going to require? Is it going to require like 5 days worth of price action or weeks of price action? Or is it just going to require one up candle, then continue its downwards move? So that's why that's the short term, that's the little intraday jaw on liquidity. Alright, and an MS shift is just the same thing as a market structure break, right? The same characteristics, but narrative is what matters. So MS shift, we have break of a high with imbalance there. You can take that imbalance as a long. Okay, it's the same thing that happened here, but this is reacting from a weekly bearish order block from the higher time frames, long-term perspective, and this is just retracing, create that lower high here, here. This daily bearish order block was the intraday draw. MF shifts cause retracements inside the range. So here, long-term perspective level, that creates the long-term high. We'll talk more about long-term highs, long-term lows in the next episode. Here, MS shift causes that retracement for a lower high. We know that this long-term high here is going to hold unless it becomes validated. But it becomes very clear if we close above that level, then that is broken. So it's just more information across the business. But I digress. After the retracement is done here, because of the MS shift, the parent order flow continues the bearish trend. This is the parent order flow. Long-term perspective level continues the bearish trend. So like I said previously, this MF shift can cause 1 or 2 days of bullish price action, right? But the intended bearish trend due to long-term perspective level is going to continue after the retracement is done, and then you have like 4 or 5 days of bearish selling days. Okay, so understand the difference between a market structure break, MSB, and a market structure shift. You can see here, this retracement here and market structure shift is just for that lower high. Alright, but since the market structure break happened here from this weekly level, once that retracement is done, because it hit the intraday draw, the parent order flow continues trend, and you can see the displacement on the downside is aggressive. So now let's talk about market maker models. So now that we understand market structure breaks, narratives, long-term perspective, and intermediate-term perspective, it becomes a lot more easier to understand what a market maker model is. So the market maker model here is you have the original consolidation, accumulation, smart money reversal, distribution completes the market maker sell model. Okay, this is my favorite pattern. So smart money reversal is just this right here, where you have a long-term perspective level hit, market structure break occurs, whatever was the bullish trend here becomes a bearish trend here. It's the exact same thing with the market maker sell model. Whatever was the bullish trend here becomes a bearish trend here, and all these support level breaks and all these resistance levels hold. Okay, the smart money reversal is identified from that long-term perspective level with the market structure break. Bearish institutional order flow on the intermediate term perspective is what happens afterwards. So we understand that there's going to be displacement on the downside, supports are going to break, resistance levels are going to hold. It's the exact same thing here, where you have distribution and distribution all the way until the market maker sell model completes, which is below an old low. Okay, so this is entire sell model here This is what it looks like when we add long-term perspective, intermediate-term perspective. We add all the supporting ideas around it. And this is what I'd like to think is the most advanced way of viewing market structure. This is a lot more advanced than just viewing higher highs, higher lows. This is understanding the complete story between market structure. So here we have that same weekly bearish order block, which is the long-term perspective level. That's going to provide the smart money reversal. Okay, here's the smart money reversal. What confirms the smart money reversal is the market structure break. You can wait for the market structure break and then short the retest. That's going to be your low risk sell. Okay, then after that, since we understand that there's going to be bearish institutional order flow on this side, every up candle becomes a selling point, or gaps becomes a selling point. Okay, but this side we're focusing directly on distribution. Okay, so we're going to have displacements on the downside, resistance levels holding, and support levels breaking. You can see here we have support gets broken here, support here gets broken, all the way until the market maker sell model completes. So notice how all these support levels break on the downside here. Broken, broken here, broken here. But until we reach that bearish order block, this market structure break didn't make sense. Okay, so all these levels here are buying for buying. This gap here is for buying. These down candles here, bullish institutional order flow, are for buying until we hit this level right here. Then that's a smart money reversal. We're no longer looking for buys. We have a market structure break. We see that resistance levels are holding, and we're just going to be targeting all these support levels to break and then clearing out the lows. So once we now understand the market maker model, we can use the market maker model for internal range and external range liquidity exits. So we know that, okay, this side is supposed to break, but what can we target for it to break? Well, we have sell side liquidity here in a discount. We have fair value gap in a discount. We can target. And then we have the original consolidation, which is external range liquidity, and that's when the market maker sell model completes. Now let's talk about playing with institutional order flow. So once again, institutional order flow, you have to identify, is it going to be bearish or is it going to be bullish? What helps you with that is the narrative. What does the higher time frame say? Then confirmation. Here, do we have confirmation that the institutional order flow is from bullish is going to switch to bearish? Okay, confirmation is in. Now we expect all resistance levels to hold, so we're just taking shorts and shorts and shorts. You could look for longs, but just know that that's a low probability trade. So if you understand that there's a market maker model in play here, you want to stick to whatever side of the curve that's on. So if we're on this side of the curve, you can see that shorting would be a really bad idea, right? Because price is going nowhere on the downside when you try to short, and it's just a really bad idea. It's the same thing here. Okay, you could try long this up into here, but there's just no point. It's just a low probability trade. Stick to what the market maker model is telling you. So now that we understand that, okay, this entire move right here to target all these targets here is going to be bearish. Okay, bearish institutional order flow. Resistance levels are going to hold, support levels are going to break. It's just that simple. Now we can start implementing the power of 3. Okay, so once we know that smart money reversal is in, okay, and we're gonna have bearish institutional on the downside here, we can mark out the daily ranges, which is midnight open to New York close, which is 16. On the hourly chart, it's supposed to be 1630, but we'll just use this. Then, if we understand that bearish institutional order flow is bearish, we already have our daily bias. Okay, we have a daily bias. We know what we're targeting. We know when to stop targeting that, and we're just going to be selling above daily opens, looking for range expansion on the downside. Okay, here same thing, and this is how you find partials. Like, a lot of people ask, where do I take partials? Where do I take profits? Well, narrative really helps, and market maker models really help. So you can take a partial here, 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 because you're framing it on the context of that market maker sell model we had. So that's going to be it for this episode. The action step for this episode is, I want you to frame a market maker model setup using a long-term perspective. Alright, so find a level from the long-term perspective. Make sure it's a high probability level. Then I want you to frame a potential market maker model on it. So once you have all these factors, jump into the intermediate term perspective and start looking for those institutional sponsorships. Okay, where did it shift? What support levels held a break? What resistance levels held a break? Where was the displacement going? And where is the original consolidation? Then, as an additional bonus to that, what you can do is start framing out power 3. So if there's bullish institutional order flow on the market maker model, then start looking for bullish power 3 setups. And with that said, I'll catch you guys in the next video. Hello everyone, welcome back to Market Structure Masterclass. In today's video, we're going to talk about ICT Market Structure Advanced. So let's start with the market narrative. What is the current market narrative? Understand that everything you do on the lower time frames must be based on the context of the higher time frames. The main goal we're striving towards on the higher time frames is to identify where the banks and financial institutions want to bring price. Banks and financial institutions operate from a long-term perspective. We are then navigating from that perspective with all the details found in an intermediate term perspective and a short term perspective. This gives us all the details of price action we need to find a plethora of repeatable, one-directional trading setups. Finding a narrative from the long-term perspective should not be hard, it should be obvious. The financial markets are only doing two things. It's either hunting a liquidity pool, or it's either rebalancing an imbalance. It's your job to determine what's currently going on from the long-term perspective, so you can align your setups on the lower time frames to fit that narrative. And failing to do so would be considered low probability trading. So, once again, finding a narrative should not be hard, it should be obvious. And you'll see that there'll either be an imbalance nearby, or there'll either be a liquidity pool nearby that just jumps right at you. And this becomes a lot more easier when you remove all the indicators from your chart, or anything covering the details of candlesticks such as moving averages. You'll see that price is either trying to seek an old imbalance, or it's trying to seek a liquidity pool. That's it. So it's your job to determine which is more likely to occur. and you just gotta figure out, okay, what's the closest one, and use the closest one as your drawn liquidity and bias. And if, let's say, the closest one is this imbalance, well, that's your drawn liquidity. And then let's say the imbalance starts to break, so the imbalance is not holding anymore, then you can aim for the sell side liquidity below the imbalance. So that would be your next objective, your next drawn liquidity. And let's say the sell side liquidity pool, we got a clean close below, then look more to the left. In the past, is there any other imbalances where price is more likely to go and fill? Or is there more sell side liquidity? You keep doing the same thing over and over and over again until you get some signs of, alright, the trend is probably going to stop. So let's get into this. So here we have a daily chart, and narrative on the daily chart here is not that clear. You see this imbalance over here, price just overshot the imbalance. So where's the next objective? Well, we have this order block here, we have this imbalance here, and then you have these sort of clean highs here, okay? But it's just not very clear to us at the moment. So what you want to do is shift up a scale. So if the daily chart's not clear, you can shift up a scale to the weekly chart. So now we can see that the narrative on the weekly chart is very clear, and we're going to use this as our long-term perspective. Then we can go back down into the daily chart, and it will just be a lot more clear when we blend those two perspectives together. So let's start with, what was the previous story? What was the story behind price here? What happened previously? So this is what you want to do. You want to walk through what price has recently done and where it's most likely going to head next. Okay? So what has price previously done? Well, we have a price range here from this high to this low. My bad, I'm supposed to draw the range from this low to here. So imagine that it's retracing within this range here. Okay, so it'd still be in a premium, but I just used the wrong swing low. Nonetheless, it's still the same. So this is the previous range. Price traded back into a premium and reacted off this fair value gap on the weekly chart. That set the stage for 1, 2, 3, 4 bearish weekly candles. Where is it aiming towards? Well, it aimed towards this bullish weekly fair value gap here. Okay, so that was one potential drawn liquidity. And what if that breaks? Okay, if this imbalance breaks, then we can start aiming for the sell side liquidity below here, which is external range liquidity. So this is internal range liquidity because it's inside of this range. External range liquidity is outside of the range, which is the most extreme prices. So you can see here, we've reacted off the previous weekly bearish fair value gap. We've had displacement on downside, breaking this weekly bullish fair value gap. So what's next? So we can see that with institutional sponsorship as well, we can see that resistance levels are holding. If we look to the left, all resistance levels are holding. We can see that supports here are breaking. So supports breaking, resistance holding. So that just tells us that if price hits another resistance level, then that resistance level is going to hold. And after that resistance level becomes active, then we're going to aim for the next support level, and we're going to anticipate that support level to break. So since in the previous chart we've already rebalanced this old imbalance, the next objective of price is to hunt sell side liquidity. So you just want to take it step by step and follow the trend. You don't want to be playing against the trend on the weekly chart, because these trends are set in stone for a long time. If we look at this trend up higher, you can see that this was an entire year worth of bullish trend. And you can see this trend lower, this was also an entire year of bullish trend. So you don't want to be calling tops and bottoms, especially on the weekly chart, you want to be sticking with the narrative, which is resistance, holding, supports, breaking. So now that we found the next narrative, which is hunting the sell side liquidity here, how are we going to get there? All right, we don't want to be chasing it down there because it's pretty obvious that it's going to go down there. But when price moves, it walks. It walks with up candles and down candles, up candles and down candles. So if it wants to walk over here, we can pretty much join that move with walking up, then taking a step down towards that sell side liquidity. So how are we going to get there? Well, we must find a key resistance level from a long-term perspective that would propel us down to that area. So what's the current price range? We have this high to this low, and we have this volume imbalance, which is essentially a gap. So that is an area that could send us down towards sell side liquidity. Okay. So now we're going to blend both the weekly and daily chart together. Okay. So now we can see that with the context on the weekly chart, the daily becomes really clear and we have clarity in our trading. How do we have more clarity? Well, we have a dealing range to work within. This high to this low. We don't want to be looking for sells in a discount market where it's extremely cheap. We have a target for price to draw towards, the sell side liquidity. And we have a resistance level from the weekly we can refine on the daily. So you can see that this bottom end of the ICT volume balance, it's still in a discount market. So we want to make sure that we could refine that on the daily chart because it has more detail than the weekly chart. We want to refine it so we can make sure that's in a premium. So how can we do that? Well, price is already reacting off the weekly volume balance, but it's not in the premium yet. This is when you want to look within the weekly levels range, but define it to a daily level. So you can see this is the high of that volume balance and this is the low of that volume balance. Okay, what do we have inside of that range? We have this old high. Right, so if you remember the previous episodes, that internal range liquidity pools such as this, a swing high within a range, can become a resistance level. So we can breach that into a premium condition here and dig deeper into that ICT volume balance. Okay, that will act as a resistance level in itself. So there's an internal range liquidity pool within the volume balance and we're in premium conditions. We now have a narrative to work within the lower time frames. So if you remember the first slide, we said everything you do on the lower time frames must be based on the context of the higher time frames. Now we have context to work within on the lower time frames. We have a nice level we can work off. We have a level that price wants to draw towards. That is narrative. Okay, so every time we go into lower time frames now, that is going to govern every decision we do. Before we get to the draw on liquidity, we will also have short-term targets. So this would be old lows here, or older blocks and lows. And these are just short-term targets because we know that price is not going to go from this high to the sell side liquidity pool in one move. It's not going to have a flash crash. We know that there's going to be up days and down days, up days and down days. So these short-term targets are what we want to aim for as objectives for our style of trading, such as one shot, one kill. Okay, one shot, one kill is basically 5 days of trading, but if you refine it down, it's actually 3 days of trading. Looking for a trade on Monday, Tuesday, Wednesday. Those are pretty much when you can look for trades on one shot, one kill. So that would be basically 3 candles, and this would be a perfect objective for one shot, one kill. You're only looking for 75 pips. Or day trading, right? This short-term target will be your bias for the week. And then the next week, you'd aim for this one. The next week after that, you aim for this low here. And since they're opposing our narrative, we want the market to trade down towards sell side liquidity here. We expect these short-term targets just to break, okay? So we expect them to break and offer a retracement, or just close below and just completely keep starting off towards this sell side liquidity here. Nonetheless, this is how you find partials, okay? So you just want to be having a drawn liquidity and short-term targets where you can basically trim off a position or bias for a week. And you can see here, since it's opposing the parent order flow here, we expect them to break. Market goes into a little consolidation and just continue to trend towards our sell side liquidity. And we can see that the majority of the candles are down days as opposed to up days. Okay. So now let's get into classifying swing points. So before we get into classifying swing points, this is a brief overview on swing points. Okay, so a swing high is a 3-bar candlestick pattern, and the fourth one is going to be basically like willingness. So like it wants to move in the swing high's direction. So you'll see a 3-bar candlestick pattern, and then the fourth one would be willingness to drop lower. Swing low is the same exact thing. Okay, so you have 1, 2, 3 candlesticks. The third one's going to close above this. That would confirm the swing. And you want to see the fourth one have some follow through up. Okay, so same thing for the swing high. You have 1, 2, 3 candles. You want the third one to close below the first one. And then you want to see the fourth one have some follow through, such as willingness to drop lower. So now that you understand swing highs and swing lows, it's time to classify swing points. So when I talk about classifying swing points, it's basically like framing long-term highs, long-term lows, intermediate-term highs, intermediate-term lows, or short-term highs, short-term lows. So you need to put them in a category, and this is what makes ICT Advanced Market Structure technical science. So before you can start classifying swing highs and swing lows, you need to have a narrative and terminus. So you need a source of price to move down, and you need a target. Then you need to understand swing highs, swing lows, which we just covered. And next, you need to understand rebalancing imbalances. So if you don't have proper understanding of imbalances, then you're going to have a hard time identifying rebalance intermediate term highs. So you need to know what those are. The narrative and the terminus gives us context behind the structure we're identifying. So if this is the source and this is terminus, terminus means where price is going to end. Okay, as it could be a short-term target, such as those previous swing lows, or it could be the draw on liquidity. Okay, basically where we're going to end either the week or where we're going to end the day. Once you have that, you can start classifying all these little peaks and troughs towards that point. And you can label this one as a long-term high, intermediate-term high, long-term low, yada, 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 right? So you could start classifying swing points more clearly. The structure of price, you can classify it with narrative and terminus. Otherwise, you're just taking a shot in the dark. Imagine that you're identifying that as an intermediate-term low. In reality, it's not. It's a short-term low before price goes up here and you got stopped down the move. So you need to have narrative and terminus to give context the key word here is context behind the structure you're identifying. So here's the narrative. We hit a daily liquidity pool, and it's not going to turn really clean like that, because that's classical support resistance. With liquidity pools, you're going to see the bodies of the candle sweep above it, get everyone above here bullish, buying lows, and that's what we call a purge. Okay, so once we're up there, how far do we know it can sweep? We can start looking at these figures here. There's such a thing called institutional figures, which are the 0.8 level, or the 0.2 level, or the mid figure level. Okay, basically you can use the mid figure level and you can project that in 10, 20, 30 grade sweeps, and that's how far price will hunt above a key liquidity pool such as this daily one. So here, this daily liquidity pool is blended pretty much with this mid figure, so we're going to sweep that mid figure by 30 pips. 1, 2, 3. So 500, 600, 700, 800, that's 30 pips, and that called the high. Okay, so now we're on the intermediate term perspective, and we can see, okay, is that high, this one, is that going to be confirmed? Okay, yes, because we're looking for displacement, market structure breaks, and imbalances. We see here market structure break, because this trend here is going to switch into this trend here, so that's the market structure break. We see displacement, because this move here has gaps. Okay, and we're seeing support levels break over here. Also, when price swept above the liquidity pool here, why didn't these cause a long time highs? Well, you don't really see a market structure break. Okay, this high didn't cause a market structure break. This high did cause a market structure break, and it swept by 30 pips with displacement as well. So the narrative will help you classify swing points. Intermediate term order flow is subordinate to parent order flow. Intermediate term swing highs and lows are linked to the parent order flow. So this level right here, this acts as the parent order flow, and all these little peaks and troughs, swing highs and swing lows, they're all linked to this source of parent order flow here. Okay, so if we know that that's the source and that's going to be the long-term high, then we can identify all these little swing highs and swing lows pretty easily until we have a clear objective being met, which is the sell side liquidity here, and that's terminus. That's when we say, okay, right now we're just gonna pause. Anything can happen over here. Might have to retrace, might close, or might just continue dumping lower, right? We wait for more information after a market maker sell model completes, which is this low, high, low, low, or basically when it takes out a key sell side liquidity pool. Okay, basically what we're waiting for is, does it want to see willingness to go down or reverse? Because this was a liquidity pool on the daily chart. All right, so that is a higher time frame level, but since it's opposing the parent order flow here source, we're expecting it to break. Okay, but if this daily level did see some sort of market structure break, then that would give us more information, wouldn't it? So now we have narrative, we have terminus. Okay, classifying swing points becomes way more easier to do. Okay, so the narrative is from this, we're going to trade lower to here, first objective. So now we can start labeling every single swing high and swing low, and how we can take action on that swing high and swing low. So without narrative, there is no context. Okay, and without context, it's hard to classify swing points. So now let's talk about how you can classify swing points, starting with long-term swing points. Long-term highs and lows are formed at a higher time frame level. We want to frame our trade setups around a higher time frame level. So with the example we've been using, it was framed off a weekly resistance level, which is the weekly fair value gap. That high that caused the displacement lower, okay, after that displacement from the weekly level, we want to classify those swing points, okay? So the one that hit, the high that hit that resistance level and caused displacement that broke previous structures, okay, we want to classify those swing points as long-term high and long-term low, right? So after reacting to that higher time frame resistance, price will form a parent structure range. So the parent structure range would be this long-term high to this long-term low. That's the parent structure range. Basically the range that was formed after hitting that higher time frame resistance level. Now, since this long-term high reacted to the key resistance level and caused displacement that broke market structure, we're going to expect that high to hold because that's the source of the order flow. That's the source of the parent order flow. Okay. With the long-term low, we're going to expect that to break since it's opposing the parent order flow. So price in subordinate structure can just start retracing until it hits another key level, and then it's going to trade lower, and we're going to expect this low to break since it's opposing the parent order flow. Refer back to video 1 and you'll know what I mean when I talk about parent order flow. If the long-term high breaks, the level becomes invalidated. This is when you sit on your hands and wait for market structure to align with your bias again. So what if price reacted off this resistance level, formed a displacement, breaking structure here, okay, and we classify that as a long-term high? Well, if we close back above it, well, that becomes invalidated, okay? The level, this weekly resistance, pretty much becomes invalidated, and you just want to sit on your hands at that point. You don't want to have any revenge trading. It's just a cost of business because that weekly resistance breaking could set up weeks of trend again, and sometimes losses are just a cost of business because it tells you more information of what's happening. This could have been a long-term low, and then you could have bullish weeks continuing after that, and then you could have had a 70% hit rate on those weeks, but you just took one out here. It doesn't matter, okay? Play the long run, play the long game. Don't judge your trading on one loss just because a weekly resistance level got invalidated. So once again, here we have the source of price, the weekly level. So it's basically this one, but we're gonna, since it's liquidity pool, we have to expect it to sweep above that liquidity pool in 10, 20, 30 grade pip sweeps. Then after we see displacement here, displacement that breaks structure and support levels, okay, that gives us confirmation that that level works, okay? And this now is the long-term high since it reacted off that higher time frame resistance level. So that's your displacement, and this is the parent structure range, okay? So this is where it started, that's your range high. This is where it ended, that's where your range low, okay? So basically, your long-term low is going to be classified when it starts retracing, okay? So did it start retracing at this low? No. Did it start retracing at this low? Yes. Okay, why did it start retracing? Well, we just took out an old low. Okay, so liquidity pools can offer retracements. Okay, don't forget that. Opposing liquidity pools can offer retracements. Notice how resistance levels hold against long-term high and support levels break. So here, long-term high is printed because we hit that higher time frame resistance level. Any opposing support levels, since we have confirmation that it wants to go down with this market structure break, any opposing support levels here, we expect them to break. This order block here, clean close below it. This order block here, with this imbalance here, and this low, we're going to close below it. So we're anticipating the long-term low to break also, since it's opposing. The long-term low basically just gave it the retracement into, first of all, back into premium from this low to this high, and also into this imbalance. So this is what it would look like on the daily chart. You have the old high here, you have the sweep above the old high, and the displacement low. But since you can't really navigate, you can't find an entry just by using the daily candles. So you need to navigate this entire move with the subordinate structure. And the subordinate structure gives us the details in price action to navigate this parent order flow. So you can see all these little details in price action. That's what we can take action on. But the daily parent order flow here doesn't give us any details to work within. So we're going to navigate that with subordinate structure. Subordinate structure is linked to the parent order flow. So you can see here, after long-term highs in, all these little peaks and troughs, okay, they're all linked to that high here, okay. So you can see how we are taking action by trading on the subordinate structure. Now let's classify intermediate swing points. When you have a long-term swing point established, which is here, you can now start finding intermediate term swing points. Alright, so it's step by step. It starts with a long-term swing point, then you start breaking it down with the context, intermediate term swing points. Long-term swing points give you the narrative for your trades, narrative and context, and intermediate term swing points give you the framework behind your trades. Right? So if this is if we're executing if our framework's off this intermediate term high, there's no reason to use this high or this high, because the framework is built on this high here. Okay? Or if we're down here already, okay, we're not going to use this high or this high, because the framework is based off this high. There are two types of intermediate term swing points. There's a classical one and a rebalanced one. Okay, so classical intermediate term high is when you have a short term high to the left, just a normal swing high, and you have that higher high, and then breaks lower. Okay, this higher high here, we're anticipating this, since this structure broke here, we're not expecting it to make another higher high, aren't we? So we're going to anticipate this to form a short term high, and overall to form an intermediate term high. Okay, and on this short term high here, that's when we want to take action. Okay, so with the context and narrative, let's imagine the context and narrative is bearish. We have a framework established here. We want to participate then on the short term high, and expecting this high not to break, since it's going to form an intermediate term high. Okay, so this move here forms the actual high. This breaks, shows us willingness that it wants to form a high, and then once this starts breaking lower, that confirms the intermediate term high. Okay, what about a rebalanced intermediate term high? For this one, you need a an order balance to the left of the chart, you'll see that on the move down, there'll be an old imbalance, and that will form the intermediate term high. So ITH for intermediate term high. Then we're gonna expect and anticipate that to be intermediate term high. So on the pullback, when it forms a short term high, okay, and it breaks down lower again, we're gonna classify that as an intermediate term high. Okay, and all of this has to be done on anticipation. Okay, so what I mean by that is, the moment you're trading, with live data, you're not gonna see this high until it's hindsight, and you say, oh, okay, that's a short-term high. You have to anticipate it to be. So you have to say, okay, that's a short-term high, that's a higher high, and that's a market structure break. So I'm expecting this one to be a short-term high, and then once price breaks down lower again, here, that confirms the intermediate term high. Okay, then it starts to fit the whole picture. Same thing here with this rebalance intermediate term high. When you're trading live data, you're not going to see this. Okay, this this high, this high. You're not going to see it. So you're just going to see price hit the imbalance, have displacement lower here, displacement lower to the downside. Your job is to anticipate this short-term high and trade lower. Okay, then in hindsight you'll see, okay, it is a rebalance intermediate term high. Once again, before we continue, I want to say that you're finding these intermediate term swing points on the intermediate term perspective. Alright, so when it comes to long-term highs, that is framed off the high time frame resistance level. Then when it comes to intermediate term swing points, that is framed on the chart, such as the 60-minute chart. It's framed on your intermediate term perspective, because that gives you more details. Then with the more details, with the little peaks and troughs, the little internal range liquidity pools and bounces, you can start classifying classical intermediate term highs and rebalanced intermediate term highs. You're not going to find a rebalanced intermediate term high on a daily chart unless you're treating that daily chart as your intermediate term perspective. The key point here is intermediate. Okay, intermediate means it's on your intermediate term perspective chart. Now let's get into the significance of a rebalanced intermediate term high. Now this one shows and tells interbank traders that it's very weak. Okay, it's very weak because it couldn't have that fake out because it's just too weak. So it just showed some weakness by creating a lower high. Now if you have been studying SMT divergences very closely, you'll see that on one correlated pair there will be a high high, and on one correlated pair there'll be SMT divergence, because that pair was weaker and this pair is stronger. So you're basically, in terms of structure, this tells you a lot about SMT divergences, okay, and which pair is weaker of the two correlated markets. We'll cover that more later on. So after an intermediate term swing point forms, we can anticipate a failure swing to occur. What I mean by this is, the failure swing is this. So after ITH forms here, this is the failure swing. We're expecting the failure swing to form, and we want to participate on that failure swing to trade lower. Okay, same thing here. This is the failure swing trading higher, and we want to participate on that failure swing to trade lower, to therefore print a rebalance high and complete the swing point. Failure swings are retracements for us to take action on and participate on. Since the intermediate term swing point gives us framework, the retracement has logic and reason to participate on. So in this example, I want you to focus on these intermediate term highs here and here, and all the way into our target here. Okay, we're not expecting a retracement from here all the way up to here and fill this fair value gap. No, because structure in classifying swing highs and swing lows has already told us that this intermediate term high is in, this intermediate term high is in, so the next one is here and here. Gives us framework to start looking for short-term highs to trade below to the downside here. Okay, so our framework is within this high to this low, or if we're keying off this, this is our framework from here to here. So you can see every intermediate term high that forms and the break lower, we can anticipate a failure swing as a retracement, and those retracements, these failure swings, are opportunities for us to take action on. And since the intermediate term swing point gives us framework here, the retracement has logic and reason to participate on. So here we have another intermediate term high, breaks down, takes out short-term low. Retracements of us, opportunities for us to take action on. So once again, this failure swing here, we want to take action on that short-term high. Failure swing here, we want to take action on that short-term high. So what would that look like? Well, here's a 15-minute chart, which is the short-term perspective chart. Basically a chart where you want to look for entry purposes. We'll talk about that in the next point. But here, with our framework is this intermediate term high. That's the framework. Then we have a break in MS shift right there. MS shift. Then we can start looking for an entry. So we're going to use the optimal trade entry. Okay. This high to this low hits the sweet spot, and our stop loss is above this intermediate term high, because if that intermediate term high breaks, then our analysis is basically flawed. Okay, and using the optimal trade entry strategy, we're going to target 0.5 deviations, and we're blending that with time since we're coming up to the daily candle close, which is 15-hour mark, and that sets us up for a nice 4-hour trade in the New York session. So since we have based our framework on this swing point here, it will act as a invalidation area for us. So we can say that we don't want to see price break this intermediate term high, because we're framing our trade on it. With logic and reason, this failure swing gives us the opportunity to participate on it. If this intermediate term high breaks, that's a cost of business for us, since we know that an important high has just broken. I want you guys to realize that if intermediate term highs and lows give us the framework, long-term highs and lows give us the narrative, if an intermediate term high breaks, that can give us clues and more insights on what's going to happen next for the long-term perspective. Okay? Because you're going to get these clues on an intermediate term perspective a lot faster than a long-term perspective. So if an intermediate term high does break, that could give us potential clues for what's going to happen next on the daily chart, or what's going to happen next on the weekly chart. So therefore, every time your trade gets invalidated, we say that's the cost of business, because it tells us, okay, what's going to happen next. Because every time we frame a failure swing, it's based on logic and reason that this intermediate term high should not break, since it's either rebalance intermediate term high or it's a classical intermediate term high. So it should hold. In a downtrend, you don't want to see highs break. You want to see highs hold. You want to see order blocks hold. And you want to see swing lows break, since these are opposing to the parent order flow. So understanding this will remove that impulsive behavior to revenge trade. So if you can classify your swing points very clearly, and you have complete clarity to frame your swing highs and swing lows off on, if this high breaks, you'll say, okay, that tells me more information, rather than it causing a lot of emotions in you that causes revenge trading. So you can't revenge trade on a framework that's flawed. And if this high breaks, that means this high was flawed. Okay? The framework was flawed. So there's no point on revenge trading on a framework that's flawed. Otherwise, it's dumb trading. So, rules for intermediate term swing points. If the intermediate term swing points breaks, expect that analysis to be flawed. Do not force another trade if this happens. Wait for market structure to get back in sync with your expectations, and that's how you prevent revenge trading and getting angry when you trade and ultimately blowing your trading account up. So now let's talk about short-term swing points. Long-term, intermediate term, and short-term swing points all serve a specific purpose. Long-term swing points give you narrative. Intermediate term swing points give you framework. Short-term swing points give you entry methods. So let's talk about when you're switching from that intermediate term perspective into the short-term perspective. So from the day trader's perspective, when you're going from a 1 hour to a 15 minute, okay, switching perspectives. The intermediate term swing points gives you the framework to use on a short-term perspective. So don't classify swing points on a short-term perspective. The objective of the short-term perspective is just for entry purposes. Okay, so you're not identifying long-term highs and long-term lows on a short term, right? The only thing you're doing on the short term is, where's my stop loss? Where's my entry? And do I have enough time to get there? So that's when you look at, okay, how long do I have until London close happens? The end of London close happens? Or when I hit that 16-hour mark or the 15-hour mark, how much time do I have to get to my targets? That's it. But when you're on the intermediate term perspective, that's when you are looking for rebalanced high, classical, or a classical intermediate term high, and gives you a clear structure point to work within. And also a clear objective you can find. So now let's talk about participating in failure swings. Given the framework, the failure swings give us logic and reason to participate on a failure swing. Okay, so the framework is here is like price retraced into this imbalance. We expect that to be an intermediate term high. So if we did retrace, we're going to take action on that. Where can we target? Clean lows here. We must make sure that our entry on the short-term perspective also follows time theory Otherwise, it's a low probability trade. So, like I've said countless times, price moves in business hours. Those business hours are London, New York, and anything outside of those business hours, you'll see price be inactive. So here we have intermediate term high, breaks lower, taking out the short term low. We know that might offer retracement. If it does, that is an opportunity for us to participate on. Now we know that this retracement here, which is a failure swing, that has logic and reason for us to participate on, because we expect this to be an intermediate term high, which also follows time theory. Okay, so midnight opening, we're expecting price to form a Judah swing. That Judah swing forms an intermediate term high. Price then breaks down with displacement, leaving gaps. This failure swing happens. We're going to take a short. I'm going to put a stop above this intermediate term high, because that's a clear invalidation point, right? If it breaks this intermediate term high and closes above this imbalance, that just tells you that the logic and the analysis was flawed. So that's when you have to wait on the sidelines and wait for things to get back aligned with what you think is going to happen. Here you can see two failure swings here. We want to participate on these failure swings because price just printed an intermediate term high. So what we want to do is we want to wait for kill zone. We have a market structure break here with displacement. Price leaves imbalances. We can take action on these failure swings with this imbalance inside a kill zone. So take an entry there. You can put your stop above here, or if you're a very conservative trader and you're scared that it's going to go up again, you want to put it at, okay, where is a clear invalidation point, which is this intermediate term high, because that's the true intermediate. That's the true invalidation area. Okay, if this high broke again, that would mean that your logic and analysis was flawed. So simple strategy, waiting for an intermediate term high, then a market structure shift, leaving a fair value gap inside a kill zone. You take an entry inside that fair value gap, and you have a target here. Bam. That's one strategy you can take, which is the most common one. This is also another common one, which is the optimal trade entry. You have an intermediate term high here, so you know that this high is in place. It gives the framework. So if we do see a market structure shift, we're going to use that range, and we're going to wait for price to hit the sweet spot, which has a fair value gap, by the way. Sweet spot there. You put your stop above this high, and since it's in a time in a kill zone, which follows time theory, we're going to expect that to be a high probability trade. And price displaces down because it's banks and financial institutions are behind this trade, so it displaces down. You can start taking partials at 0.5, 1, 1.5, and 2, all the way until you have the daily close, which is that 15-hour mark. Alright, and that's how you use the long-term perspective, the intermediate-term perspective, and the short-term perspective, and you're classifying all these swing points so that when you do look for entries, it becomes easy. You have so much clarity. You just look for that shift and that fair value gap and that time kill zone to work within. All this becomes so much easy, so much clarity, and it will remove all that overthinking that you'll have if you didn't do any of these steps, right? If you didn't do any of these steps, you would basically have overthinking, or you might second guess your entries, or you might hesitate to enter just because there is not any clarity behind your trading. But all these little swing points gives you framework, and that intermediate term swing high or swing low that you frame a trade upon basically will remove all that overthinking you're going to have when taking that trade. That kill zone also removes all the hesitation, because you know that price is going to move within those hours. So all these little factors will just make you a better trader, because it gives you clarity. And yeah, I'm super happy to show this to people, but if it wasn't for ICT, then I wouldn't know any of this. So big shout out to my mentor ICT, and yeah, he's the only reason that I'm able to do this and able to show you guys how to do it as well, walk you through the process. But now let's give you the action step. Okay, so how do you use all this information and what to do for, from this point and take action. So what I want you to do now is I want you to start classifying your swing points in your study journal. Alright? Follow the narrative. Otherwise, it's going to be very hard for you to classify these swing points. So the narrative is just that long-term perspective level. Then once you go in the intermediate term and the short term, you start classifying each swing point. So that's all we have for today's video, and I'll catch you in the next one. Hello guys, and welcome back to another video. In this video, we're going to talk about swing projections for market structure targets. So let's talk about the long-term perspective and market structure breaks. Before we can start to use swing projections for targeting, all the steps shown in episode 1, 2, 3, and 4 must be present. Swing projections are the last key step to trading with clarity. They will give you profit objectives to aim for. So here we are on the long-term perspective, and specifically we're going to look for market structure breaks to start looking for swing projections. So we start from the long-term perspective, and we want to identify when the market is ready to reverse. So if we look here, price has retraced back from this dealing range high to this dealing range low. Price has found some internal range liquidity, and we're blending that with a fair value gap. Right, so this is a high probability fair value gap because we have an internal range liquidity pool, and we have premium conditions, and we have the fair value gap itself. When the market is ready to reverse, this will be confirmed with a significant market structure break. So since we're looking at a resistance level, price will rally into the resistance level, and when that rally is ready to reverse, when this bullish trend is ready to reverse into a bearish trend, we can confirm that it's ready to reverse with a significant market structure break. So, a significant market structure break is the invalidation of a classical or rebalanced intermediate term swing point. This is why interbank market structure is more detailed than retail market structure. So that is the same fair value gap mentioned in the previous slide. Sure, we have market structure break here and market structure break here, but if you want to see the full trend reverse, something similar to this, if you want 100% conviction that it's going to reverse, you want to see a significant market structure break, and that could be seen with breaking a classical rebalance intermediate term swing point. So here we have a fair value gap, price rebalances that, forms a low, then rallies into the resistance level. Sure, these are little market structure breaks, but if you want to see this trend reverse, this entire trend reverse,
rather than just looking for a little day trade or scalp, make sure that you're basing that off a significant market structure break. After a market structure break is shown, we can then start measuring swing projections for targeting purposes. There are two dealing ranges to use for swing projections. We can use either the parent price range for a measured price leg, or the failure swings for a measured price swing. So let's talk about the measured price leg. So a parent price range consists of a long-term high and low, and was used to create or cause a significant market structure break. So that's the same fair value gap as used in the previous slides. This is that market structure break, and this is when it started retracing. Okay, so this is the long-term high because it hit that long-term perspective level. This is when it started retracing back to the range. So this is the long-term low. We're going to expect this to break in the future, but we're going to use this price range, a premium discount, and defined levels to take action on, so we can target this low and many lows to come. So the goal for a measured price leg is to see a one-to-one extension of a parent price range. So here again is where it starts to retrace back into a premium. The parent price range is a price range that reacted off the high time frame fair value gap and caused a significant market structure break. That range, we want to mark that out, long-term high, long-term low, and then we want to extend this out for a one-to-one extension, and that should be our first profit objective. Then the goal for swing projections is to blend that with price levels. So if you really want to get precise, make sure to blend the extension with a price level to the left of the chart, and you want to be using liquidity, order blocks, or fair value gap. Price can far exceed the one-to-one extension, especially under the context of the long-term high. So the context of the long-term high was we wanted to see the market reverse from bullish trend to a bearish trend, and that could be confirmed with a significant market structure break. We then want to use the parent price range and aim for at least a one-to-one extension. But if we understand that the context of the long-term high is to fully reverse price, especially with the narrative and context from the monthly and the weekly chart, then price can far exceed a one-to-one extension, okay? Especially if it wants to go lower, especially when there's equal lows here, and we want to complete this mark and make a sell model. So just have one-to-one extension as an objective for profit taking. But know that since a long-term high is formed, those highs are going to stay for a while, right? That's going to act as the source, the parent order flow for bearish move to come, right? If we get the one-to-one objectives, we can start aiming for 1.5, 2, 2.5, and we want to blend all these swing projection targets with price levels. So here we're in the discount market. We want to sell high and cover that at a discount, right? That's good trading. So we're going to use the swing projections, and we're going to find, okay, what levels are in a discount. We have low here, swing low here, swing low here, So all of this is internal range liquidity because it's inside this range from this low to this high. We then have an internal range liquidity exit in terms of fair value gap with a 2.5 deviation swing projection. And we also have this clean lows, which is external range liquidity. We can blend that with 3 standard deviation swing projection. Alright, so we're blending these swing projections with price levels, and we want to see it at least hit 1, but under the context of this being a long-term high and the market wants to trade lower, then we can aim at these accordingly. So a reminder, the closer we get to targets, the more oversold, overbought price becomes. Therefore, it's important to have short-term objectives along the way. These short-term objectives can be used as one-shot one-kill trading and day trading, acting as that directional bias. So just because it's trading under the context of the long-term high doesn't mean we're going to have a flash crash and trade there within 1 or 2 days. When price finds a drawn liquidity, such as this external range liquidity pool, it walks and it trends towards that point with up candles and down candles, up candles and down candles, up candles and down candles. And that's because price, as it walks, price tends to get oversold and overbought. Okay, so you need to understand that the more we trade into the discounts, the more we could see retracements. So therefore, if you have an opportunity to take profit at a 1-to-1 swing projection and an internal range liquidity pool, you have to take something off because price is in a discount and price is at a really cheap price. And obviously, you can hold for long-term objectives, but just pay yourself for your time, your energy, and effort in the market instead of regretting it afterwards. It would also make a lot of ease and pressure on yourself as well when you take something off, and it will make holding for these long-term objectives a lot easier. Okay. Measured swing. So measured swings focus on failure swings. Okay, so let's recap what a failure swing is first. Failure swings are engineered moves. The intent behind them are to build a short-term discount and premium condition. Whilst building a short-term discount or premium condition, price will seek an intraday or week draw on liquidity. Therefore, the purpose of a failure swing is to build a discount premium whilst also meeting market making objectives. So let me just quickly explain this graphically if you didn't understand. Let's say we have a long-term level here, and let's say price is trending up towards that long-term level. Price breaks market structure with that significant market structure break. Now we have the long-term low, and we have a long-term high. Failure swings are engineered to build in this case, a short-term premium. So we're going to view this retracement into a premium, which is above 50% of this range. This move is a failure swing, okay? Because it's designed to fail in the future following the narrative of the long-term high. The intent of this failure swing is just to build a premium market. So go above the 50%, okay? But whilst building that short-term premium price, trading into premium here, price will seek an intraday or intra-week drawn liquidity. So that could be trading back into a fair value gap. Okay, So that could have been the intraday draw liquidity, trading it back into a fair value gap. Or it could have been trading back into internal range liquidity or an order block. Nonetheless, it could have been an intraday drawn liquidity. When focusing on failure swings to trade back into a drawn liquidity, it's best to see, okay, is there a fair value gap, right? So you want to be aiming for that fair value gap for a rebalance, all right? Because when it rebalances, if we take a look at the structure in this case, we can see that we have a short-term high here, which makes this an even more significant long-term high, which tells us more that this is a very key turning point, right? So remember, rebalanced intermediate term swing points, and another one here, especially when this reacts with a long-term perspective level, that's going to form a very long-term high. Okay. So now instead of using the parent price range for targeting purposes, we're going to use and project out the failure swing for swing projections. So once again, if we have a long-term high here, a long-term low, this is the parent price range. Okay. We can also project that out for swing projections, but for measured swings, we're going to use a failure swing that trades back into a premium in this case. We're going to get this low to this high, and we're going to project that out for targets, and we're going to blend them with price levels, such as liquidity or fair value gaps. So first, let's establish some context from the long-term perspective. Here we have a range, low to high, discounted prices, last down candle in this range. Okay, so that's acting as a long-term perspective level. Within this long-term perspective level, we're blending it with the daily chart. Okay, because if we didn't know what's going on in the monthly, then the daily chart would be, well, it'd still be pretty clear, but if you really want clarity, then incorporate the monthly as well and blend it with the daily perspective like I've done here. So we have a high for breaking market structure. Okay, so that's an important high. If we're going to retrace, we're going to trace within this range. So when people draw out daily ranges, make sure that you're drawing it out from a high that's been taken out like this. Because if price trades towards this rebalance here and trades lower, that made a rebalanced high, which is key, right? And this is internal range liquidity. But if you're using this dealing range here, it's not a key high to be drawing out your dealing range. Alright? Because first of all, look to the left, it's clean. Second of all, it's going to stab up into this and rebalance this anyways. So there's no point of drawing your Fibonacci from this high to this low. Use a key high like this one here. So we're going to blend that monthly order block with a daily chart. What is the daily chart telling us? Well, if this is the range, prices, discounted prices. Very cheap. We've taken out a low here, stop run, and we formed an aggressive order block, stabbed into it, and take a look at this. Order blocks breaking, okay, supports holding. So what does that tell you about the monthly order block here and the stop run? So we have to aim for, we have to find a narrative. Where does the market want to trade to? In this case, we have two areas that price could trade towards: liquidity pool and imbalance. So here we have internal range liquidity in form of premium highs, and we have an imbalance, and that's going to be the source of drawn liquidity. So when we're looking for day trades, we're going to be focusing on bullish bias. Alright, so take a look at how many bullish candles are here compared to the bearish candles. When the market is ready to reverse, this will be confirmed with a significant market structure break. So if we see a support level, price is going to decline and completely reverse that when we have a significant market structure break. So here, clean highs. Inside that monthly order block range, we taking out lows, which is a fake out. We cleanly close above these highs, which is the market structure break. This is a failure swing. Okay, what did this failure swing do? Created a short-term discount. We know that when price trades below a low, this is extremely discounted, right? Especially looking at the context with the monthly order block. This is extremely discounted because everyone's going to be chasing down the breakout and placing their stops above here. So this failure swing created a short-term discount by breaking here extremely cheap, and whilst doing it, inducing a ton of shorts in the market with breakout shorts, which then builds buy side liquidity up here. And if these guys are unwilling to, take the stop out, then they're just going to move up here, right? Or maybe this breakout was more of a long-term play, and they did put the stop up there. Okay, regardless, there's always going to be liquidity on breakouts. We can also use this as a failure swing. What did this move do? Traded back into discount market, inducing more shorts in the market, building buy side liquidity above here, right? So we could also project this high and this low for measured swing targets. Alright, but we're going to specifically focus on this one now. So with the drawn liquidity, that's where we want to see price draw towards. And we have short-term targets such as this and this here. After the market structure break, right, we're going to use the failure swing, and we're going to project that out. So 0.5, and we're going to blend this with a price level. What do we have? Look to the left, nice fair value gap. So that could be the first target. Now we're aiming for a 1-to-1 measured swing. Look to the left, we blend that with a fair value gap. $1.5, look to the left, we have a high here. And since this high is very low resistance, might as well just use these highs as well. Two standard deviations out. Blend that with price. What do we have? We have equilibrium price point, and we also have clean highs here. And finally, 2.5 and 3 projections on the measured swing using the failure swing here. Look to the left. We're finally in that premium condition. We're trading towards that drawn liquidity, but we're framing short-term trades on these swing projections, and we're blending with what needs to be rebalanced or what liquidity pools need to be taken out on the way to the drawn liquidity. Understand that sure, you could find one setup here, stop below here, and just hold the whole thing. But if we go back to this daily chart here, this is 1, 2, 3, 4, 5. 1, 2, 3, 4, 5 days of trading. Okay, so it depends on what style of trading you prefer. Are you a one shot, one kill trader where you enter at this order block here and you hold until this. Okay? Are you a swing trader, where you enter here and you hold for this entire range until the withdrawal liquidity? Or you're a day trader like me, we just want to get in, out, in, out, in, out. Because if you're a day trader like me and just want to get in and out, then this style of taking profits is perfect, right? Because if you got in here and you didn't get out here, price would have retraced against you and you would have lost all your unrealized profits. Now that wouldn't be an issue for a one shot, one kill trader or a swing trader, because he's holding for all the way up here. But if you're a day trader, you want to get in and get out, and you want to find logical areas to get out at. So now that we have context from a long-term perspective, confirmation with significant market structure breaks, and targets with swing projections, it's time to discuss how we can manage our trades as price heads towards our targets. Managing swing projections with institutional order flow. Let's start with intermediate term displacements to higher time frame targets. The first thing to understand is that after an intermediate term swing point has been established, that will cause a displacement to our swing projection targets. So therefore, we must trust price to trend and walk towards that target with subordinate order flow. Okay, so you can see here, rebalance intermediate term low. After that forms displacement, right? We can see, look at these up candles here. These are not displacements, right? These are not displacements. This is displacement, right? Displacement to our target, which is 0.5, and this fair value gap in a premium from this low to this high. Okay, so intermediate term displacement, when an intermediate term swing low has been established in this case, that will cause displacement toward our targets. Okay, same thing here. We have displacement and displacement here. Subordinate order flow is directly linked to the parent order flow. Okay, so all these displacements is because we had that long-term low here, which is from the long-term perspective. So since this is providing the bulk of the volume in the market, we are expecting to see those displacements happen. So the parent order flow is where the bulk of the volume is generated, and we are then navigating that volume from an intermediate term perspective. Okay, so this is the bulk of the volume, and this is the subordinate order flow. And we're going to navigate the bulk of the volume, which is just up, but since it has to walk, we're going to navigate that with intermediate term lows and highs. So let's talk about intermediate term retracements. Understand that the algorithm becomes oversold and overbought as it trends towards the targets. Therefore, it's important to keep your targets and profit taking nimble. So when price is in a premium here, these levels are high probability, okay? They will cause reactions. If you have premium prices and you have a fair value gap, bearish fair value gap in a premium, that will cause a reaction, okay? So make sure to keep profit taking nimble. You don't want to hold for too long, otherwise you'll get punished, like I mentioned, and you'll lose all your unrealized gains. So here we have a rebalanced intermediate term low. We're going to frame a trade setup with this intermediate term low, and we're just going to target 0.5 swing projections, and we're going to blend that with a fair value gap. So after that intermediate term low is formed, we can see we print an order block here. We have an aggressive retest on that order block. If you look closely, there's a fair value gap too. So order block, fair value gap, that's a high probability order block. You can enter here, stop here, and just target the 0.5 swing projection. So now we want to refine our risk, and that's the short-term perspective. Okay. So we can see here, midnight opens, we have an inducement. Market creates a Judas swing, induces breakout longs here, where they're going to place a stop loss here, here, and here. And since this is low resistance, we can expect this low to get taken out. Okay, so these lows are low resistance. So breakout longs, they're getting trapped in the market. Judas swing happens when? London session. Okay, and since it hit that fair value gap, this blue shaded area, that is a rebalanced intermediate term low. Okay, so we want to frame our trades upon that. Take a look at this. We're in London session. Price creates an order block by closing above this down candle. And that order block is high probability because we have a fair value gap as well. Short-term perspective, we can look for entries in a kill zone. Entry here, stop here, targeting that objective. Since the bias is up, every session we want to be looking for buys. So here we have the index market open at New York. Opens, creates that Judas swing. Judas swing, what does it do? Takes out a low into fair value gap. Rallies, prints another fair value gap here. Pyramid opportunity into that swing projection target. Okay. Now, if price is already in the premium market and price is expensive, you shouldn't be looking for longs in the afternoon. Okay. Especially when we're at a resistance level on the premium level. We shouldn't. So, as a reminder, it's important to keep your targets and profit taking nimble. Alright? Don't be too greedy. It really depends on your style of trading though, but if you're a day trader, which I assume most of you will be, this is how you combat losing all those unrealized gains. Swing projections plus premium conditions plus a key level. And failures to do so might result in price retracing against your unrealized P&L. Retracements will occur at opposing levels influenced by time. So here, this fair value gap was opposing our bias in a kill zone. Yes, we're going to expect it to break in the grand scheme of things, but just take a look at when the market's going to close. Is the market going to trade higher when we're at the end of the market close? Right? If it was pretty early, we can expect expansions. But when the daily close is about to come up, professional traders, they're looking to exit positions. And where's the most logical area to exit? Opposing levels, influenced by time. Why time? Well, we're about to close the day at a resistance level. So that's time and price. And here's an example of price retracing against you, causing you to lose all those unrealized gains, regardless your intermediate term low. Okay? So remember that. Regardless your intermediate term low. Right? Let me explain. We understand that intermediate term swing points create displacement to higher time frame objectives. However, keep in mind, price might need to create multiple intermediate term swing points to get to these objectives. So we have one here, here, here. Okay? It's not just create one intermediate term swing low and then straight to our drawn liquidity. No, you might have to create multiple, right? When do we create multiple? Okay, once price starts hitting opposing levels. So when the premium here, what do we have here? Swing projection, fair value gap, that's opposing levels. We might need to retrace there. So it would be a good idea to close there. Price retraces, forms another intermediate term swing point. We understand, okay, that's going to form a displacement. Where? Well, we could start looking at a one-to-one extension here. Blend that with price action, fair value gap, and look at the range. We're in the premium market. Okay, that could offer a retracement. Okay, form another intermediate term low. We have a fair value gap here. Price forms intermediate term low here. Intermediate term lows form displacements to higher time frame levels. What do we have here? 1.5, 2, clearing the internal range liquidity pool here. Key intermediate term levels. Now we understand that retracements are possible. We want to manage our directional bias. Okay. So directional bias was formed on a long-term perspective using higher time frame levels. We want to manage that on the intermediate term perspective. This is done by studying if institutional order flow remains towards our drawn liquidity. So here we have two draws liquidity. We have price needs to rebalance, and if price clears that rebalance, we have the initial drawn liquidity on the daily chart. As price walks towards this area, we're using institutional order flow and we're studying it to see if price wants to remain trading towards that area. Okay, so how do we do that? We study institutional order flow. If institutional order flow is bullish because we took out these lows and we had the market structure break, do you want to see rebalance intermediate term lows break? No, you don't want to see any bearish market structure breaks. If price did trade below a low, such as this one, bullish institutional order flow suggests that as a buy. Okay, why? Because we need to trade towards these areas. So if we're bullish, we want to see resistance levels break and support levels holding. That is institutional order flow in a nutshell. Resistance levels breaking, fair value gap, swing projection. All right, it's a target, but we're gonna expect it to break in the future. Same thing here, same thing here. Why? Because we need to trade towards these higher points, framed on a long-term perspective. Those key support levels are framed on the established intermediate term swing points. Okay, so when we're looking at institutional order flow and we want to study if support levels are holding, well, those support levels are framed on intermediate term low swing points. Okay, so here we want to see, okay, this low hold. We want to see this low hold. Okay, so supports, if this low holds, and we break above this high now, form another intermediate term swing low, this must hold. So framing support levels based on this low now. Form another intermediate term swing low here. Why? Because we rebalanced this point. So we want to frame support levels on that low, and we don't want to see that swing point break. Okay, same thing here. Rebalance low forms. We're framing support levels on these lows. As we trade towards higher time frame objectives, we don't want to see these intermediate term swing points break, right? Because imagine if we hit a resistance level and we did saw a intermediate term low break, then that would be a significant market structure break, which is a clue for us when managing our directional bias. Okay, so if you're a swing trader or short-term one shot one kill trader, this part is very crucial to you. Now we must understand that we can't control price. We must allow price to do what it wants to do and trust it to trade towards the target. Okay, so we can't control this. Okay, we can't do anything. No matter how much emotion you're going to put into it, this thing's just going to do what it wants. No matter how much you pray to God, or how much you're crying, or how much you're angry, it's just going to do what it wants, okay? So you can't control it. The only thing you can control is yourself. So how can you do that? Well, place your trust in institutional order flow. Okay, and that's the beauty of interbank concepts. Interbank concepts allow you to trust institutional order flow. Resistance levels breaking, supports holding. That's the only thing you want to put your faith in. Okay, trusting institutional order flow is how you hold on these winning trades. So if you know that this thing is going to trade higher, and you're a swing trader, for instance, or you're one shot, one kill trader, and you want to hold for these long-term objectives, you're going to have to trust institutional order flow. Trust the fact that, okay, supports will hold, resistance will break. Put your faith into that. And once you put your faith into that, and you're using these swing points as essentially like a call to action protocol. Let's say we have an intermediate term swing point here, and we're expecting this thing to trade high. Okay. If that intermediate term swing point breaks, that's a call to action that, oh shit, institutional order flow is probably switching. But when it comes to trusting it, right? Even if it pulls back against you like this, you know that this low is going to hold because it's an intermediate term low. And you know what's going to happen next. Displacement towards higher time frame targets. So you have to trust that. And to trust that, you just got to find as many examples and have as much wisdom and experience in the market. And then over time, you will trust it. And once you do trust it, it will remove your greed that causes you to take early profits, and it will remove your fear from getting stopped out because you're trusting that intermediate term swing point. Navigating and trusting institutional order flow. Framework, step 1. Develop anticipation skills. So framework is built on the structure of an intermediate term swing point. This intermediate term swing point must follow the context from the long-term perspective. Okay, so you're not trading based off intermediate term swing highs, because those highs are expected to break due to the context and narrative of this long-term low. However, if you have a long-term low, significant market structure break, if price does form an intermediate term low, we're going to expect those things to hold, okay, because it's following the context from the long-term perspective. And that's why we always start from the long-term perspective, so we know, okay, because this could be a rebalanced high, most definitely, right? This is a rebalanced high, so you have a fair value gap and it rebalances, so you would classify that as a intermediate term high. But due to the context of the long-term low, intermediate term highs are supposed to break and intermediate term lows are supposed to hold. Your expectations following that framework are sorted with institutional order flow. So if you're expecting bullish institutional order flow, trust, have faith, and anticipate support levels to hold, resistance levels to break, displacements higher after an intermediate term low. Bearish candles, such as this one, view them as speed bumps, right? Speed bumps before we accelerate higher. Speed bumps before we accelerate higher. Ask yourself the following. Did price establish an intermediate term swing high? Okay, so this is not following the example, but this is what you want to ask yourself when you're in front of the charts. Did price establish an intermediate term swing high? Then we should expect bearish institutional order flow. With bearish institutional order flow, resistance against the swing high should hold, and support against the swing high should break. So if we have a higher time frame resistance level here, and price breaks market structure, we have a long-term high here. Okay, we're tracing now. You want to wait for price to establish an intermediate term high, so a fair value gap. Let's say intermediate term high has been established here. We break low. From that point on, we'd classify it as an ITH. And what happens afterwards is bearish institutional order flow. Okay, so we're going to expect displacements to the downside. We're going to expect lows to break. We're going to expect up candles to send price lower. Up candles to send price lower after the intermediate term high forms. But this intermediate term high needs to be framed on the framework of the long-term perspective. Okay? Everything I explained here, you flip it upside down for an intermediate term swing low. Framework, step 2, anticipating the daily range. So this is the beginning of framing your trading day. Before you start working within the daily range, intraday, you want to incorporate everything to give us clarity. Then we develop the skill of anticipating the daily range. So incorporate everything, like I said, everything prior to this episode. Okay? Then you'll develop the skill of anticipating the daily range. And if we're expecting bullish institutional order flow, we're expecting price to be bought on the daily opens, then displacement to the upside. Alright, so let's get into that. So here we have daily ranges. Here we see midnight opening, trades lower, displacement to upside into this level here, close of the day. Opens another day, trades lower, expansion to the upside with a displacement, trades lower after hitting opposing level, closes the day. Right? That's just bullish institutional order flow for you. So not only are we expecting resistance levels to break, supports to hold, we're also expecting price to be bought below the daily open. So ask yourself the following. Are we going to have a bearish power 3? You want to ask yourself these questions before every trading day, by the way. Are we going to have a bearish power 3? This means that a long-term high is providing the bulk of the volume to make daily candles trade lower. Because power 3 is daily candles. We want to see bullish failure swings above the opening price act as a Judas swing. We want to hunt setups within that failure swing. So let's explain this. If we're expecting this to be a long-term high, right? Long-term high means, okay, we're going to have bearish candles to the downside now. But how we're going to trade that is using the market opening price, which is midnight open. So midnight opening, we're going to expect a bullish failure swing, which is going to do what? Trade into a premium, induce longs to the market, and build stops below the market. Then, once price is doing that, we want to find shorts. Why? Because we're framing our trades based on the long-term perspective here. Then, when we look for shorts, since the long-term perspective says, okay, we're going to go lower, we're expecting all these next daily candles to trade lower with the power 3 fashion. Framework step 3. Hunting trading setups within kill zones. Finding a setup should be the easiest part due to the amount of context and framework we have behind us. Okay? This should be the easiest part, seriously. Now it's your job to find that entry pattern that stands out to you the most following the directional bias. If the trading pattern is present, fair value gap, order block, and you have completed each step of the frameworks, institutional order flow, power of 3, then when it comes to a kill zone, you need to pull the trigger. Once you pull the trigger, it's your job to relax on the trade and notice if you have any other psychological issues. So let's say you're in a trade and you're just feeling really itchy that you want to close the trade. That's a sign of greed, premature greed. Mark that down, right? Because there's repeating patterns in price action, but there's also repeating patterns in the things that you do as a trader. So when you make a mistake, it's pretty much the same mistake you've always made. So now it's time for you to write that down. Write that mistake down so that you can be aware of it. And awareness is always the first key step to solving these issues. If you do write it all down, that's gold. Like I said, you will then see repeating signs in trading flows you might face that are not related to technical analysis. This will be solved with proper mindset and psychology training. So here we have the daily ranges, we have the bullish institutional order flow, we have the directional biases going higher into these targets that we marked out, and we're operating everything in the kill zone. So intermediate term low forms in the kill zone. This buy opportunity operates in the kill zone. Profit taking operates in the kill zone. Right? Here, consolidation. But the inducement happens in the kill zone, and another buying opportunity happens in the kill zone. Everything will happen in the kill zone. Make sure that whenever you're trading in the kill zone, you're finding your entry pattern, but it has to be aligned with everything you've done on the long-term perspective and the intermediate-term perspective. So here, I forgot to mention, always frame your trade on an intermediate-term low or intermediate-term swing point. So in this case, we have an intermediate-term low. We're framing our trade on that. We have overnight rallies, AM retraces back into that order block. It's on the 1 hour chart. But that order block, price then displaces up, forms a fair value gap. Is that an entry pattern? Absolutely it is. Buys here. There's another buy here. Did we hit an opposing level yet? Not yet. So we can still look for buys. PM. Trades back to this fair value gap within the kill zone. Is that an entry pattern? Yes, it is. Buy. Take profit at that key level. And since I forgot to put, but this is after PM, you can see that price is not going to move. So you don't want to be looking for any entries out there because that's when there's no volume in the market. Kill zones will generate the most trading volume in the market. So, your action step. Set up your fib tool properly and save the preset. From a long-term perspective level, identify the significant market structure break, and using that context of the market structure break, find the new narrative, such as, are we going to trade below lows now, or are we going to rebalance, and blend it with swing projections for targets. So what I mean by this is, identify, let's say we have a resistance level here, identify the significant market structure break. Okay. From that market structure break, what's the new narrative? Are we going to trade below this low? Or are we going to rebalance this fair value gap here? Right? Whatever that is, find the new narrative. Where's it going to go next? Then I want you to use the swing projections and blend it with those targets. So you can use the parent price range from this high to this low. Or you can use the fader swing from this low to this high and project that out. Or you can use this fader swing that hit the long-term level. So if you're wondering what the Fibonacci settings are, here they are. In your Fib retracement tool, you want to have 0 and 1. Okay, so that'll mark out the range. Then you want to have negative 0.5, which is 0.5 standard deviations. You want negative 1, negative 1.5, negative 2, negative 2.5. But you're just blending all these standard deviations with price. So these mean nothing if you're not blending it with a key level, remember. Once you have all these numbers marked out, go over here and where it says template, you want to click that. You want to save it as swing projections targets. Swing projection targets. So with that being said, hopefully this video has been very clear for you guys, and I'll catch you in the next one. Hello guys, welcome back to another video. So in this module we're going to talk about ICT advanced market structure with order blocks. First of all, let's talk about what identifies an order block. So we can start from page 1. Okay, so an order block, a bullish ICT order block, is the down candle or candles before a bullish move. So if you can see, this is the first stage of an order block. This is the down candle before the upwards move, okay, before the bullish move. But if you see a group of down candles, that is also considered an order block as well. So if this was a 1 hour candle here, if this was a, let's just say a 15-minute candle, and this was a 15-minute candle, these would be considered as a 30-minute order block. So it's the single down candle or multiple down candles. You can group them together. After the price closes above the down candle, this confirms the order block. So you can see down candle, you tell yourself, okay, that's potential order block forming. And then we see the bullish move and it closes above this down candle. That confirms these groups of down candles as an order block. Okay, you could also use this one as well, but since they're grouped together, this is also confirmed. So both of them are confirmed. It really depends on how nimble you want to be. If you're a more loose trader, you can just use the group. If you want to really be precise, you can use this one. But sometimes being too precise means you might miss the move. So keep that in mind. So we have two ways to trade an order block after it's confirmed. We can trade it with an instant retest or rounded retest. So this is the two ways you would trade an order block. So after, an aggressive trader would use the instant retest, and a more conservative trader, where he needs more confirmation without like a market structure break, will use the rounded retest. So the moment price gets confirmed as an order block, instant retest is on the next candle or candles. Price will stab into the order block and rally. Okay, and you want to make sure you take profits when it does that, because it might come for a rounded retest, which would break market structure to the left first, or just simply have a retracement, something like this. It's not instant retest. A bearish ICT order block is the up candle or candles before a downwards move. So once again, if there's two consecutive up candles, you can classify that as one order block. Okay, that's where the extreme selling happened. When price was going up, the entities that move price, they're extremely selling into these up candles. Okay, and then they have displacement to the downside, which shows willingness, right? Just like an elephant in the pool, as ICT would say. That becomes confirmed when price closes below the order block, or even this one. Really depends on how precise you want to make it be. Okay, maybe if it's early in the session, like really early in the session, and you think that price could trade into this up candle during like a news event or something, that you could refine it like that. Okay, but if you just want to look for a general trade idea, you can just use the group of candles and not be so precise with it so you don't miss any moves. There's two ways to trade an order block. The first way is the instant retest, where you see it close and then it snaps right back instantly, and this is for aggressive traders. Or you could wait for a rounded retest, which would take some more confirmation, where you need, oh okay, I need the premium and the discount, and I need a market structure break to the left, so it's a rounded retest. Okay, so that's how you would trade an order block. Instant retest for the more aggressive trader, rounded retest for the more conservative trader. You have to figure out, okay, what are you particularly? Because I'm not going to be able to tell you. Now let's talk about instant and rounded retests, and I'll show you examples. So here's the first stage. Can you try guess what retest we're going to have here? So we have a market structure break in the market. So here's our first example. Can you try guess what type of retest is present here? We're just taking our kilo. And you can see how do you see what retests might be possible here? Price has taken out a kilo and broke market structure. This is when we want to wait for a rounded retest. And sometimes in rounded retests, you have internal range liquidity pools. So if you can blend a liquidity pool with an order block, that makes it a high probability order block as well. So you can see that if we did draw a range from this low to this high, and within a discount, there's an internal range liquidity pool and an order block, that is a very good indicator for, okay, this is going to have a rounded retest, which makes this order block a high probability order block as well. You can see that rounded retest has happened, takes out the liquidity pool into an order block that showed willingness to create a long-term low due to the fact that it's taken out stops here and broke market structure. Okay, very important you understand that. What about an instant retest? Well, let's say you see all these down candles here. If the intended move is up, they're actually buying every down candle. Okay, so an instant retest is the moment price closes above an order block and instantly retest it. And this is what I mean when you add all these order blocks together. this would be considered as one order block, because this is the daily chart here. This would be 1 day, 2 days, 3 days. You add them all together, and that's a 3-day order block. But if you use a single one here, that's a daily order block. And we all know that the higher time frame levels sometimes have more precedence over the daily, sometimes. Okay, it really depends on what you're looking at. So you can see the instant retest here. Closes above, stabs, stabs. This is not a rounded retest where it takes out liquidity pools more into a discount. This is just stabbing into the order block. And it prints another order block here. Right, so this is what we call institutional order flow, where we can see that down candles are going to support price, so we can expect this down candle to support price also. And you might be wondering, okay, why not use all these order blocks as well? Well, this is the most beefy range, right? All order blocks want to be beefy like this, because the true volume is in the bodies. So you don't want to be using order blocks like this, where they're just like dojis, because this is very indecisive. Use the down candles like this. And the moment price closes above it, this will now act as an order block. Similar to this. All these down candles, price closes above it, instant retest. Now we want to see the same thing happen at this down candle, at this order block. And we can see that we're getting a move. Okay, it's not a rounded retest, but it's an instant retest. And we'll talk about all the different scenarios that you can use this. So you see that the instant retest pushes price up, but you gotta be nimble sometimes. You gotta understand that just because it's an order block doesn't mean it's the low. Okay, just because it's an order block doesn't mean it's the long-term low. You need to understand that sometimes, okay, they did buy that, and that's a scalp, that's a day trade, that's a one-shot, one kill. But the next week they might just use the liquidity formed from that move and hunt that, right? As opposed to a level like this, where it's already hunted liquidity and broke market structure. This makes these types of order blocks more of a structure approach. Okay, since we have low, 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 we can anticipate a really nice swing points. Okay. As opposed to this order block here, sure, it provided buying. We could have made money on that move, but look what it left. Internal range liquidity from the clean lows, right? So why do people fail with order blocks? An ICT order block is a candlestick pattern. All candlestick patterns, such as fair value gaps or retail chart patterns, will fail if they are opposing the institutional order flow. Therefore, the reasons traders fail with ICT order blocks is that they are failing to trade aligned with the financial banks and institutions. I highlighted this red because that's exactly what you want to be doing every single fucking day, every single fucking week and month. You need to identify where do the banks and financial institutions want to move price, and your main goal is to trade with that. Because if you're doing a trade against that, you can just consider that as a low probability trade. And why people fail with order blocks is they're taking too many low probability trades. And if they did less and only focused on high probability trades, then they'd actually find way more consistency in their trading. So if you are trading an ICT candlestick pattern or retail chart pattern that is aligned with the banks and financial institutions, the pattern will have success. And I want you guys to realize that also retail chart patterns will work if they're following the banks and financial institutions. And that's why you'll see bull flags work sometimes. And the only time they work is if they're aligned with banks and financial institutions. But to identify what these guys are doing easily, we need ICT interbank methods. Alright, so if we just try to follow the banks and financial institutions with retail chart patterns, it wouldn't become successful. But retail chart patterns that follow the banks and financial institutions are successful. But get to the source, guys. The source is interbank ICT methods. That will give you exactly what's going on in price, the fucking narrative of what's actually printing on the charts, and that's why you can see so many interbank traders with consistent results and just really good trading with amazing logic and reasoning. It's not random. So, what's the keys to selecting order blocks? By understanding that candlestick patterns succeed if they are following institutional order flow, the key to selecting order blocks is then by determining what the current institutional order flow is. How do we do that? Well, what support levels are holding, are lows holding, are highs breaking. Let me draw this out. Okay, so if support levels are holding, support can come in terms of OBs, gaps, and liquidity. If all those things are holding on the way up, you can say that institutional order flow is bullish, right? And you also want to see the resistance levels that trade against it are breaking. That supports the idea of bullish order flow. Bearish order flow is just the complete opposite. This is when you'll see resistance levels holding price down with order blocks, liquidity, fair value gaps. It's holding price down, and you'll see support levels to the left, they'll just break. I mean to the right, sorry, they would just break. So what are you currently seeing then? Are you seeing bullish institutional order flow, or you're seeing bearish institutional order flow? This should do the thinking for you, and it should also take off a lot of pressure you might face as a trader. So if you're a person that can't really hold trades for a long time, it's because you're not trusting the order flow to do its job. So you have to desensitize that. You have to trust it, and then over time you do it over and over and over again, you'll eventually just trust it. We can determine the institutional order flow by determining what the narrative is. Okay, so the narrative comes from a long-term perspective, and then that will provide us the institutional order flow to use on the intermediate term perspective and even lower. So narrative can be found from a long-term perspective, and since the banks and financial institutions operate on the higher time frames. So let's talk about how narrative creates framework. Narrative aids framework. Narrative helps us create a directional bias for the upcoming days or weeks. Knowing this helps identify institutional order flow, which tells us which levels are supposed to break and which levels are supposed to hold. So what's the narrative here, guys? We have a kilo from the monthly chart, which is a support level, and we can see that confirmed with a market structure break. What's the institutional order flow here then? We can see that down candles are sending price up higher with displacement. Down candles are sending price up higher with displacement. So that's the narrative, bullish, because these down candles are pushing price up and resistance levels are breaking. Highs are not acting as resistance. They're getting closed cleanly above, and we have follow through every single candle. So we're going to use this monthly level here. Since we know that institutional order flow is bullish, we're going to use this monthly level here as our next support level. Because remember, this is a down candle, yes, right? But the more price trends into a premium and expensive markets, you'll see that sometimes the order blocks do fail and require to trade back down into a discount and find that key order block. So this order block here is really expensive, but when price trades lower, these order blocks become cheaper. So since we're on the monthly chart, we can refine this one on the weekly chart, and you can see that it gives us a nice dealing range to work within. So the dealing range has a bunch of liquidity for price hunting into a discount market, but the down candle we identified on the monthly chart, since it's on the monthly and since it's really cheap here as opposed to these premium order blocks, this is going to be very significant. Okay, so we can see that we have 3 drives lower. What does this do? It really just traps the FOMO shorts. Every time price trades below a low like this, it traps the FOMO shorts, then it squeezes them, takes them out. You gotta understand how to feel and think like a market maker. So when we have another low like this, and price breaks out like that, FOMO shorts are going on in the market, and we can squeeze them into key levels such as this, and these are even clean highs as we'll go into the lower time frames. Okay, also back into premium market. So this is all narrative, guys. We're going to refine that on the daily chart. So into that monthly level, we have a stop hunt, and this we can act off. This is what we can key off on the daily chart. We have a low taken out, and you can see that the aggressive order block gets printed, and the aggressive order block gets tested here, and where we're going to draw towards, guys, what we outlined on the weekly. So we're blending both perspectives. Okay, so that's the next draw, clean highs, and a weekly fair value gap. Then your bias is bullish. When do you change that bias? When we start going to a premium, we start hitting premium levels. Alright? So that's all narrative. And now with narrative, framework becomes a lot more easier. Okay, you can see that the market structure shifts in the market have context. The imbalances and displacements you see will then have context. The order blocks you see will then have context. This is how you don't confuse yourself. This is how you get complete clarity in your trading. And then this is why I created the walkthrough. I want you guys to realize how to trade with these concepts with complete fucking clarity. Excuse my French. So displacements make sense, okay, because it's following the narrative. Stop hunts make sense because it's following the narrative. Order blocks make sense because it's following the narrative. Resistance levels breaking. Why? Because we identified the narrative first. The narrative is, okay, we're an extreme discounted price. We've taken out another low, which is extremely cheap here, and we broke market structure. Narrative told us that. So all these candlestick patterns follow the institutional order flow generated from the long-term perspective, which is what we just covered. We can only then start classifying swing points and selecting the correct levels to take action on. Like I said, market structure makes context. This has context. Clean lows. If we see clean lows, and we know that the market likes to seek them, we want to use them as buying opportunities. And then we can blend them with high probability levels like this. Especially on the framework of a long-term low. Since we classify our lows, we know that, okay, that long-term low shouldn't break. Especially with the market structure break, confirming it. Then you want to wait for intermediate term lows. So intermediate term lows is classical and rebalance. This is rebalance because we hit this fair value gap. Do we see confirmation? Yeah, we do with the market structure shift. Off of that rebalance fair value gap, do you see this order block printed with an instant test? Then this one comes more for a rounded retest. Right? And on the rounded retest, That action in itself also creates a intermediate term low, classical one, because we have a low here and a low here. So I'm going to clean this up a bit. So by this rounded retest happening and the market structure shift, this created a long-term low. I mean, intermediate term low, a classical one. Apologies. Framework selects order blocks. So with the help from narrative, we have directional bias, and we can classify our swing points. So long-term low, rebalance, intermediate term low, and classical term lows. The intermediate term swing points will give us the framework. When choosing order blocks, we want to establish an intermediate term swing point first. So what are the two intermediate term swing points we have? We have a rebalanced swing point and a classical swing point. After an intermediate term swing point has been established, we can use order blocks to get in sync with the institutional order flow. So we understand this low should keep, and if this rebalance gets filled, that creates a rebalance or rebalance long-term intermediate term low. I get these words mixed up, my bad. So after that intermediate term swing point has been established, look at this down candle and how price has an instant retest of this. And the conservative trader that requires more confirmation in terms of the market structure shift, look at this rounded retest. Then the rounded retest created that classical intermediate term low. And then check out how the order blocks are then getting used to get in sync with the institutional order flow narrative that we have an idea. We want to see price trade higher, right? How is it going to do that? It's going to use order blocks to send price up higher. And then that's when you see two down candles here, you could be buying there. Two down candles here, you could be buying there with a gap. This two down candles here, you could be buying that, all the way until price trades back to a premium, or until your narrative says, I'm not sure what's going to happen next, so I need more information. Here is rebalanced intermediate term low, and you can see that this is a rounded retest. These down candles will use the same price higher. These down candles will use the same price higher. And that's how you do it, guys. That's how you use order blocks to get in sync with the narrative and with institutional order flow. There's also a hierarchy to order blocks. There's a parent order block, the order block that creates the swing, and subordinate order blocks, which you want to view as speed bumps. This is the low formed. We have more detail on the 1 hour chart. I'm going to wait for an intermediate term swing point to give us a framework to work within. And once that intermediate term swing point forms, like this one, these order blocks are the parent order blocks. Okay, so they create the swing, right? And these are key because they give us the framework on this low here. So you don't want to see an intermediate term low break, especially when it's keying off this. So that those intermediate term swing points and the order blocks they form are going to create the parent order blocks. Subordinate order blocks are these little speed bumps. So yes, this is a parent order block, but look at these down candles, right? They're just used as speed bumps to send price higher, because price can't go up with just green candles. It needs to walk there. It needs to walk higher. And speed bumps you must trust that these are going to send price up higher. So whenever you see price come down against you, the algorithm's kind of designed to do that, to instill as much emotion in you. But you just got to be comfortable and trust institutional order flow and trust these subordinate order blocks to send price higher. But you want to frame the majority of your trades of the parent order block, because you know that those are going to hold. And these parent order blocks, if you get stopped out on those parent order blocks, it's because it means something. It's a key stop out. It gives you more information on what's going to happen next, as opposed to just randomly getting stopped out because your stop was too tight. There's a difference, guys. So the purpose of a parent order block is to create the intermediate term swing point. The purpose of a subordinate order block is to send prices higher or lower towards the drawn liquidity. Intermediate term swing point and institutional order flow. Intermediate term swing points and institutional order flow. Intermediate term swing points create swings that lead to higher time frame objectives. So the drawn liquidity that we have, the short-term targets that we have, every time price creates an intermediate term swing point and it confirms, those are the lows that are going to send price. It's going to generate a swing in the market. So if you can see that this is a rebound slow, you can see it generates a swing. After this classical low was formed, it generates a swing, right? Rebound slow generates a swing. And this is displacement, guys. And it has context because of what we outlined on the narrative. And the narrative is to trade higher into a premium to where the magnets are, or where you have to rebalance, and where we also have to take out the clean highs. After the intermediate term swing point forms, we can expect price to have displacement towards our levels, and subordinate order blocks are used to send price higher. We want to trust price action to trend towards the higher time frame objective with institutional order flow. Institutional order flow, and no parent order blocks and subordinate order blocks, and the purpose of the both. Intermediate term lows, especially when they're established, should not be violated. Like I said, guys, this is market structure from an interbank level. And market structure kind of tells you what price is going to do next. So if you're expecting bullish prices like this, but then you see rebalance lows breaking, that's not a sign of institutional order flow being bullish then, right? Signs of institutional order flow being bullish is highs breaking, lows holding. And if a low did get taken out, then it trade right up higher again. Like this, these lows here. It trades right back up higher. So if price did close below an intermediate term low, from a market structure standpoint, then that's a sign that there's a potential reversal in the market. So every time these lows get taken out, you should never be disappointed, because there's no such thing as 100% trading, and there's no such business that only makes profits. Every business out there, a restaurant, hotel, whatever, there's going to be a cost of business, right? So whenever we take a loss, we know why our loss happens. It has so much logic and reasoning behind it. So that loss is not really a loss, it's a cost of business, which is amazing, since we understand our losses and we can use them to better our trading. Also, if you frame your trade base on an intermediate term low or classical low or rebalance one, right? Any intermediate term low, if you frame your trade off of that, then you should be comfortable with your stop being below that low. Because since it's an intermediate term low, it should hold. So if you see yourself getting stopped out before every move too early, try this next time. Try framing your trades, hence the name framework. Frame your trade off an intermediate term low first, and then start looking for trades. So an important reminder, the closer we get to our objectives, the lower probability the subordinate order blocks become. Right? So the closer we get, imagine we start trading in the premium now. These subordinate order blocks are just speed bumps. They're not really an intermediate term low or parent order blocks. So they don't have much significance. So if we do trade higher into oversold, overbought conditions, you gotta be aware that those might actually not hold. It might need to have a rounded retest. Okay? A rounded retest. This is because price trades more and more into oversold, overbought conditions, which is premium discount. Okay, so it's always important to be aware of premium and discount conditions. That's how you have high probability trading. So now let's talk about framing a setup with high probability order blocks. And we can start off with framework and narrative. So how does framework and narrative make a high probability order block? So framing a setup with high probability order blocks. Before we start finding setups from a short-term perspective, we must use the framework from the intermediate-term perspective. Therefore, a violation of the intermediate-term low will be a cost of business with logic and reasoning. So we're not really looking for entries on the intermediate-term perspective. We're looking to create some sort of idea here. We're looking to create ideas on the intermediate term perspective. Then with those ideas, we go into the short term perspective and we execute on it. So we can create a very favorable risk to reward situation. So when you want to frame your setups as well, you want to mark out the daily ranges, all right? The daily ranges also gives context between these frameworks and when you should see price expand and when it doesn't. All right, you can always see that these, majority of the time, these intermediate term lows form during important hours, right? This one, yes, as well, since you can see that it doesn't rally until midnight. It starts to rally. You see, so you gotta make sure that okay, this is a low formed outside of important hours, but look, it doesn't move yet. It starts moving inside of important hours. All right, otherwise it wouldn't be consolidating. So now let's talk about fair value gaps and liquidity and how they make a high probability order block. So now that we're in an intraday short-term perspective where we're looking for entries, remember, we all want to frame our setup off an intermediate term low, okay? So that's what we frame the setup of, intermediate term low. Why is this an intermediate term low? Because of the fair value gap. Okay. Now we can understand, okay, what's going on here in the short-term perspective as well. Well, we consolidated overnight in the largest session. Then this move right here broke below these lows, which is sell side liquidity in form of previous day's low and intraday's lows, induces shorts in the market, and this is all happening within a bullish context narrative, right? So when you see this stuff happening, but you know that on the long term is bullish, on the intermediate term is bullish, you should see these moves as trapping people, right? If you're just staring at the 15-minute and you saw that, you would be, oh, that's a market structure break, and I'm going to short the retest of that. That's because you're only looking at the 15-minute chart. But since we've done a top-down analysis the fucking proper way with clarity, we can see that long-term perspective and intermediate-term perspective is bullish. So these moves shouldn't phase us, and we should be doing the quite opposite. So that forms the low. Now we can start looking for order block setups. As you can see that this down candles with upwards move, it gets confirmed, right? And you can also see we have a rounded retest into that order block at optimal trade entry area, right? So this is oversold in terms of the range here. That's where you want to select your order blocks. You don't want to be selecting order blocks in the premium, especially when we're creating that intermediate term low. Alright? Then we can use subordinate order blocks to send price higher. But this is creating the parent order block. And then we can see subordinate order blocks sending price higher. And here as well, sending price higher. Where? To the short inducements liquidity. Now to make the order blocks even more high probability, right? The 15-minute is what ICT calls the bear weather. If you don't like to take this trade, because this might be a bit this is like 2R. If you want to make it like 5R, 3R, then you're gonna have to refine it, right? So if you don't like the risk model, the risk to reward model on 15-minute, then you can always refine it on the 5-minute, right? But following the framework on the 15-minute now, right? So you can see that we can shift down perspective. This is short term, but we can shift down perspective in the short term for more detail, right? You see what I did there? So now we can see that this creates a very nice pattern. We have a low taken out, you have the market structure break, trades back down into optimal trade entry, into an order block. But look what we have here. We have 3 drives, internal range liquidity, and we also have price hitting a fair value gap, right? If you missed that, no worries. Since we know that institutional order flow is bullish, we'll just do the same thing with future down candles, right? Low, market structure break, trades back into optimal trade entry, and we can see that this had a fair value gap with it. Right, so I know I'm rushing it, but take your time and really study these charts. Okay, so you can see a more clearer perspective here. And what's our drawn liquidity? Well, we have a gap here, right? So we know that gaps want to fill, especially when we had. I emphasize this point over and over again. Narrative and framework is bullish, so we should see these gaps as targets as well. We should see the liquidity pools as targets, right? And we can see fair value gap here, internal range liquidity, speed bumps and price higher. So these are parent order blocks in terms of the short-term perspective, since price high. What also makes a high probability to order block? Time of day. Let me start by saying this. If you're looking for order blocks outside of time theory, you're simply pissing on your own feet. Please don't look for order blocks outside of a kill zone, because like I said many times, these markets are designed to move specifically within these hours. And the most important thing is to trade aligned with the banks and financial institutions. But if you're trading outside of kill zones, then you're not doing that. It's as simple as that. Morning session creates a low, an important low as well, right? So all these key lows are formed in kill zones that do their business around these hours. So bring back everything from the previous slides and bring it to this point here. This swing point is going to form in an important time of day, such as the morning session or afternoon session. So we also want to be framing our exits within time theory as well. So if you can see on the chart, we are about to hit that daily range close with the vertical line. So that's when you want to be looking for an exit strategy blended with price action, and that's why you have price running out the short inducements liquidity. So this would be a perfect exit for the daily range, with entries found in the morning session and afternoon session. So how is this set up conservative? We have a low, we have a market structure break, and we have a return optimal trade entry. Do you see the rounded retest? Right? So rounded retest is for those more conservative traders. We have a low here, market structure break, we turn back into optimal trade entry with this order block, fair value gap, internal range liquidity, with time theory. So many factors to make you trust this order block. Right? Not to mention the framework here, and the narrative from the dailies. So many factors. So rounded retest happens, and then since it's the end of the day, you want to close it, right? So it's outside of time theory, that's when you should close, especially when we're taking out short inducements liquidity. Now the aggressive trader, they're going to have a better risk to reward, since their stops are going to be a lot tighter. So here, invalidation level is below this low, because it's the fair value gap, the keying off of. Same trade would be net you 5R. But since conservative will have looser stops, since their stop is based on this here. Aggressive, they're basing their trade based on the order block or fair value gap. So here they're basing on the fair value gap, entry here, stop below here. Same thing here. You can also be aggressive with the order block, so the down candle that forms the intermediate term low. See price stabs here, here, here. So all of this is what you would have to withstand its heat, but your stop is protected nonetheless. You can see that provides a higher risk to reward since it's aggressive. But aggressive versus a conservative trader means that since conservatives have more confirmation and more conflict and less aggressive, they're gonna have stop outs a lot less. Aggressive traders are going to have more stop outs, but they're going to have higher risk rewards. So this comes to the close of the video, and I want to introduce you to the action step. So using the framework provided, identify order blocks with advanced market structure. So advanced market structure is long-term perspective, intermediate-term perspective, short-term perspective, classifying all these swing points, and then using that framework, identify the order blocks. So after you have classified your swing points, start identifying order blocks drawing to your higher time frame objectives. We know that intermediate term highs and intermediate term lows swing price towards the higher time frame objective. And these are the charts I want you to screenshot, and I want you to mark it up for yourself. Okay, using Paint or whatever you want to use, Photoshop, do your homework on these charts. Hello guys, welcome back to another video. In this video, we're going to talk about high probability trading versus low probability trading. So, the code behind trade ideas. There are only two kinds of trades we can take, a low probability trade and a high probability trade. High probability trade is a trade that is in alignment with the long-term perspective and intermediate-term perspective. Low probability trade is a trade that's against the long-term perspective and when the intermediate-term perspective retraces. So, high probability trades is when you have a long-term high in, break in market structure confirming that long-term high, price retraces, creates that failure swing, forms an intermediate term high, breaks market structure again. And if you're taking trades that are aligned with these two perspectives, that's a high probability trade, especially when the drawn liquidity is clear. This could be a fair value gap, internal range liquidity exit, or an external range liquidity exit when it comes to clean lows, right? So if we take trades that are aligned with the long term, intermediate term, and the drawn liquidity is clear, that's a high probability trade. Low probability trade is when you're trading against that framework. So let's say you see a buy signal here and you expect the intermediate term perspective to retrace up higher, maybe to a fair value gap here, back into a premium. You can take that trade, but just realize it's low probability since it's against the narrative and context and intermediate term swing points in the market. Okay, if price does form an intermediate term swing low due to the context narrative from the higher time frames, this is expected to break. All right, so if you're taking a trade based on it, yes, it can go up and fill a fair value gap here. Yes, you can make a certain amount of pips, but just know that it's a low probability trade. So you have to distinguish between the both, because we treat these trades differently, hence the code behind trade ideas. So let's talk about high probability trades. Since these trades are in alignment with the long-term perspective and intermediate term perspective, it is in your best interest to let the entire trade run instead of closing half of it or closing it all out entirely. So in terms of target, high probability trades have a further target. So let's give you an example with a one shot, one kill example. So we're going to start on the long-term perspective here at the euro dollar. Price is retracing within this range here. This low to this high. Okay. Before we target these lows here, we still have an internal range drawn liquidity in terms of this fair value gap. So price should come rebalance that. Study what's happening here. Price is showing signs of bearish institutional sponsorship with resistance levels holding and support levels here breaking. So we want to stick with that. And how can we get aligned with that? Well, we have a fair value gap here. We should anticipate that to be a long-term high now, okay, because it's a higher time frame level. And where's drawn liquidity that we can aim towards? This low first, and then this fair value gap. So since that hit the higher time frame level, sure, you might have got stopped out on this one. It happens, but this happens again. Okay, retest that level and breaks this low with displacement. Price rebalances fair value gap, and now since we have a long-term high here, a rebalance high becomes intermediate term high in terms of structure of this point here and this point here. So if we have an intermediate term high, and what do we expect? We expect bearish institutional order flow to take place now. So up candles such as this one will act as resistance, and we should be aiming for downside objectives, right? Because the drawn liquidity is here. But before we go to the drawn liquidity, do you see any price targets from this high to this low? If this is the range we're trading in, what's the price targets? Well, we have a fair value gap here. We have a fair value gap here. These are internal range liquidity exits we can have for a short-term target. And we also have this low. So we could be aiming for these points, but ultimately in that draw liquidity. So that's the order block. This is the internal range liquidity exit and external range liquidity exit. We're going to be aiming for those points. Okay. And since it's aligned with the weekly chart and the daily chart, we're blending both of those perspectives together. Now we have a clear view that, okay, price wants to trade lower. Would it make sense to close early at this point? No. It would make sense to hold for a big move, since we can expect big moves to happen at higher time frame levels. And just take a look at the market structure here at these higher time frame levels. So there we have it. We have a big displacement, But let's study how we could have entered this on a lower time frame. So this is the intermediate term high, which is the rebalanced fair value gap. Okay. Price pierces into the order block at the intermediate term high, then broke market structure, which is a confirmation sign that it wants to reverse now. So do you see the parent price range? Here, here, okay? We're going to treat this as a long-term high in terms of this daily level, okay? But this is an intermediate term high based on the weekly level. So this is the parent price range. Since we're expecting downwards price action to our targets here, if price trades back to the premium, that's a short. We expect this high to hold since it's with the narrative and context. We expect this low to break. And this pump right up here, sure, it looks enticing that, oh, it might go up higher. But that's the point of a failure swing, guys. Failure swings are meant to trap people to ultimately fail. So you could use premium discounts or you could use optimal trade entry. It's pretty much the same thing. And what we're doing for swing projections here is we're using the parent price range. We're looking for a 0.5 extension, which brings us to the high of that fair value gap. 1 to 1 extension, which brings us to the low of that fair value gap. 1 to 5, which brings us to that external range liquidity exit. Price retraces back into a premium. So this is where the failure swing is anticipated to stop, right? Failure swings stop in the premium because it's already met its market maker objective, right? Market maker objectives for a failure swing is to trade into a premium, induce longs in the market, build sell side liquidity down here, whilst also meeting objectives, taking out shorts here. Okay. So in that optimal trade entry, we have our targets. Now let's study the structure. So since it's at daily level, acts as long-term high, long-term low, that's the price range. We're in optimal trade entry. This failure swing, study what it did. It took out this high. And since we're going to anticipate this high to hold now, this high should be lower than this one. And if this confirms, that is an intermediate term swing point, a classical run, right? A classical intermediate term swing point looks like this. All right. So once we expect price to trade back in optimal trade entry, maybe there's no short entry here, but look at this. The moment we hit optimal trade entry again, we have a displacement or a fair value gap. Pair that with an order block, right? And since this is a short-term high and a higher high, price should not see itself come back above this point again, especially under the context of this long-term high. Okay, we should then expect all opposing levels, such as this order block or this fair value gap, to break, this fair value gap to break, and then ultimately this long-term low to break. And then once the long-term range breaks, price can make its way to those swing projection targets. So you can put an entry at that order block and fair value gap, stop above the intermediate term high, since we're framing our trade based on the intermediate term high. Stop above that point, entry at the order block fair value gap, holding towards swing projection targets. And that's one shot, one kill. Since it's aligned with the long-term perspective and intermediate term perspective, if we see an entry pattern and it's following these principles here, and the weekly chart as well, of course it's going to have a big move to the downside. Okay, and really, you don't have to hold for as long as 10R. 5R is great. Or you could just close below this low, and that would have been perfect, right? If you really want to hold for these longer term objectives, you can leave 30% of your position running, okay? You don't have to hold the full risk to these points, because imagine how you would feel as a trader. You'd probably be struggling to sleep and everything. So it really depends on if you can handle it or not. If you can't, that's completely fine. So low probability trades. Since these trades are against the long-term perspective, it is in your best interest to pay yourself partials around logical areas. So logical areas are opposing levels or an opposing liquidity pool. Pay yourself when there's an opposing level. Okay. Since at any time or any moment the intermediate term perspective can snap back into alignment with the long-term perspective, it makes sense to close partials and pay the trader. So what I mean by this is, if we have a resistance level here, price is traded into that resistance level, and we have a parent price range already. Okay, this is the parent price range. This is long-term high. This is long-term low. A low probability trade is once you're trading a retracement, okay, against the long-term perspective. Okay, you're trading that retracement. But since at any time the intermediate term perspective can snap back into alignment with the long-term perspective, okay, you want to take quick profits, right? Don't hold for when you get absolutely extreme prices to exit. No, if you see a liquidity pool here, take it. It could be a 2-to-1 trade. It could be a 1-to-1 trade. Just pay yourself, since it's considered a low probability trade, and at any time, since it's opposing the long-term high, this could snap back and trade aligned with the long-term perspective. And you want to be trading aligned with the long-term perspective, because that's a high probability trade, and you can hold for longer displacements in the market. So we're just using the same chart here. You can see how these are relief rallies, right? And that's counter trend setups. So maybe on the 5-minute here, on the 15-minute here, you could take a long, because this is a daily level. This is an opposing level that can cause a retracement, right? This is a daily level. It can cause a retracement. So you could take a long here and exit at this fair value gap, right? But imagine if you said, oh, I'm going to hold for this fair value gap here. Watch how price just snaps back into alignment with this whole framework here. Okay, so these are low probability trades. Same thing here. Price at a daily level in terms of the external range liquidity exit. Maybe there was a buy here, right? You can see how it taps this order block real quick and rebalances here. That is a trade, but since you're going against everything here, it's a low probability trade, because at any moment, price can just snap back and trade back into alignment with the long-term perspective. So for the most guaranteed way to find consistency in your trading, stick to high probability trades only. Okay? Short-term high, intermediate-term high, a market structure shift, failure swing back to premium, order block with imbalance, take short there. Okay, optimal trade entry, just a simple pattern. But you want to be trading aligned with the long-term perspective, because not only will you have bigger moves, right? It's more high probability. Trade aligned with the higher time frames if you want to find the most guaranteed way for consistency. You don't have to be scalping up, down, up, down, up, down, up, down, up, down. There's no point. If you want to find consistency, you want to make this work for you, there's no need to be trading like that. All you need is one good trade a week. Imagine if you're able to make 4% a week, right? You just risk 1% on this trade here, and you just found one good setup. But you can do that every week. Is that not consistency? Is 4% a week not good enough for you? Or maybe it's 8% a month. Since you should be aiming for 8% or 10% a month, just trade with high probability trades. Because if you did choose to take low probability trades, that could lead to a downward spiral. One loss could lead to another loss, and another loss, and another loss, just because you get more emotional. But if you take a loss based on the higher time frames, that's information, right? It's telling you something. It's a cost of business. But if you're taking a loss on a low probability trade, is that really a cost of business for you? Is it telling you that the market's going to reverse? No, it's just telling you that you're probably forcing trades. So to not force trades, be more patient and focus only on high probability trades. And these are trades that are aligned with the higher time frames. So let's talk about some poor performing trading habits that you might have. 1. A poor trading habit is framing your trades without any context of the long-term perspective. So like mentioned previously, to find success with interbank methods and concepts, everything needs to be following the long-term perspective. A fair value gap or an order block doesn't hold because of the name. There's nothing special about a fair value gap or an order block if you're not following the right context of the market. Everything needs to be framed under the right context and narrative, and only then will these interbank patterns unlock for ultimate precision. So like, let's say you wake up and then you just jump right into the 1 hour chart. You didn't check what the daily's doing, the weekly's doing, none of that. And you're looking at these interbank methods such as order block and the fair value gap. Okay, this one holds. So you're expecting, okay, another one, because we just broke market structure. The previous order block and fair value gap holded. That's another market structure break. I'm going to take the next order block and fair value gap. But there's no context. You can't just trade based off a market structure break. That's not good enough. Since this is an order block and fair value gap, that's a high probability pattern. But without any context, it's almost guaranteed to fail. So let's give you some context here. This is the context. Price is trading from this high to this low, and price is an extreme discount. So if we're going to make our way back into premium, you'll see buys happening towards that. Look for buys in this area. We're going to frame our trade off the long-term perspective. So we have a discounted market. Okay, ticking out low. It looks like it's going to retrace back for drawn liquidity in terms of the rebalance here. So how is it going to get there? Is it just going to go up, 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 up? No, it's going to walk there with down candles and up candles, down candles and up candles. So if we see a down candle in a discounted market, we're expecting that to be buys. Okay, so this order block prints for an aggressive entry, tap. This is the moment we go into a intermediate term perspective or short term perspective, and we start looking for buys all the way into premium fair value gap. Or it doesn't even have to be that premium fair value gap. If you look before that, we have a internal range liquidity pool here. So you could have looked for a buy here and out here. So now we have context. You can see why these trades fail now, right? You can see how these A plus trading setups are expected to fail. Because if you're looking at this and saying, okay, that's a market structure break, with context, you're shorting support at this point. You're shorting support at this time. Okay? With your trust in institutional sponsorship, even if the opposing setup is A plus, we expect it to fail. Okay, so even if you say, oh, up candles, resistance, up candles, resistance, it's not good enough. You start with context from the long-term perspective, then you identify institutional sponsorship, then you can trust institutional sponsorship. So with context, you can see how easy it is to identify institutional sponsorship, and then select your favorite interbank pattern to get in sync with institutional sponsorship. So this order block here is acting as the parent order flow. We have a market structure break. We have a breaker. We have a low, high, lower low into the level. Liquidity pools can cause reversals. We close above it, retest, and there's a small fair value gap in there. So breaker and the fair value gap is an A+ setup. But you don't even have to know if there's a breaker there. You can just say, oh, that's a market structure break. That's a higher time frame level. Okay. My entry pattern is a fair value gap. That's it. You don't have to know these breakers. It really depends on what you see best. So we have a displacement to the upside. Due to the parent order flow, we should see price trade higher aggressively. Maybe you didn't catch anything up here. You wait for an intermediate term swing point to frame your trade on. So we see here, rebalance, creates an intermediate term low, displacement, can take action, find support levels based on that intermediate term low. What do we have? Well, we have all these down candles, consecutive down candles. So 1, 2, 3. We're going to add that together, and that's going to be a 3-hour order block. 50% of that is a buying opportunity, but you don't even have to know about order blocks, right? Maybe you are better at trading optimal trade entries than this low to this high, framed off an intermediate term low. 62%, targeting that general liquidity, and swing projections for the optimal trade entry. Okay. Same thing here, rebalance low. We can look for support levels based on that, and that could be a little scalp. Okay, but the moment we hit that general liquidity, stop. Okay, that's where you want to end your trades. You're not expecting it to break, you're waiting for more information in the market. So another poor trading habit a lot of traders have is rushing entries at the weekly open. Okay, so maybe it's Monday and straight away in Asia, they're looking for trade setups. Rushing. They've been waiting all weekend. Well, I can't wait till the market opens. I want to get an entry. I want to make some money. Well, let me tell you some truth, guys. Trading is not like any other business. More trading hours does not amount to better trading results. You can't force a trading setup when the price is not bound to move. So any other business is, they like to follow the hustle mindset. So, this I'll sleep when I die mindset, or I'll put more hours so I can get better results and beat my competition. Trading is not the same. For trading, you have to wait for price to move. And if the banks and financial institutions not ready to move price on a Monday, then it's just going to trade in a small range. Okay, Monday might trade in a small range, and if price is not moving, then how are you going to find trades? How are you going to find a one shot, one kill setup? You can't. Banks and financial institutions understand that retail traders are in a hurry to find trades on market opens. Knowing this, prices will stay stuck in a range and trap as many retail traders inside the range. So you can see this with the daily range, you can see it the weekly range, you can see it the monthly range. I'll give you an example for the daily range. Asia will normally trade in a consolidation. And then London will form that Judas swing, take everyone out on Asia, and then trade lower. You see, Asia is the first session of the daily open, and people are in a rush to find an entry at daily open. But if it's not ready to move, then it's just going to trade in a range. And then you'll see this pattern so many times. We can do the same thing at the weekly open. Where weekly opened, Monday doesn't do anything. and then Tuesday or Wednesday takes out all the traders on Monday or Tuesday, and then completely reverses. Okay, because the retail traders that were hurry to find trades when the market opened, they're stuck, and their liquidity is going to be used to pair orders to bring the market down lower. So knowing this, knowing that traders are in a hurry to find trades when the market opens, banks and financial institutions will trap as many traders in here, so there's liquidity building above the market and below the market. Sell stops, buy stops. Okay, they're accumulating all this liquidity, so when they're ready to take action, they can use it. Because banks and financial institutions, they're such large players, they need to build liquidity for their orders. They can't just click buy and sell like me and you. They have to build it. And how they build it is by keeping price in a consolidation. Think like a market maker. So here we're on the long-term perspective. This is a daily chart. Here we have a fair value gap. Test it once, test it twice, taking out an internal range liquidity pool inside the fair value gap. Okay, so that's a high time frame level. You can see it hits a resistance level here. We're going to study on the lower time frames how price reacted. But since we're expecting price to go lower, sell some liquidity, targeting institutional figures, let's study what happened here on the lower time frames. So even though it follows your typical long-term high, long-term low because of this daily level here, okay, that's your parent price range. This is the weekly open, and imagine the rush to find trades here, 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 okay? It's trapping traders and it's building liquidity in the market. Now I'm going to tell you how do you know when price is going to break out that range for trading the weekly range. How do you know when it's not going to be in a consolidation? How do you know when to trade Monday? How do you know when to trade Tuesday or Wednesday? How do you know when not to trade Monday, Tuesday, or Wednesday? It all depends on the economic calendar. So study the economic calendar every Monday because that's going to give you the clues for the weekly range. Okay, so the clues were staring at you the whole time. There's no news on Monday, so there's no smoke screen, there's no excuse for the markets to move. So this is when the market's going to stay quiet because there's no excuse, such as high impact news, for price to move. There's no volatility. We have news on Tuesday, right? But you gotta look Monday through Friday. What is the main news event? You can see the main news events of this. So if the main news events are late in the week, price is going to hold for those news events. And then once news events happened, volatility happens in the market. Okay? And all these retail traders that are rushing trades on a Monday, Tuesday, anything before the main news event of the week, they're going to get fucked. Excuse my French. So this was the main news event. Okay? And notice how after this point, price starts moving. Okay? Following what we had here. So don't be in a rush. Okay? You can see the moment the news events happened, clean trading happens. You have a high. New York kill zone forms a high. Displacement to the downside because we're in the resistance. We're expecting lower prices. Bearish institutional order flow. We're shorting resistance levels. We're expecting support levels to break. Okay? Asia happens. Displacement. Fair value gap. displacement, fair value gap, displacement, and all these moves are happening in kill zones, which we'll talk about in a bit. Okay, but just study how price finally starts to move after the main news driver happens. But before the main news driver happens, everyone's getting trapped. Everyone's getting trapped. And you might have experienced this yourself. You might have entered a position, price didn't move, and you're at the point where you don't want to close the trade because you're invested so much emotionally in it. And then you're holding it for 1 day, 2 days, it doesn't do anything, and then out of nowhere it just jumps. Well, this is how you combat that. So warning, there are exceptions to this rule, okay? If price has reacted to a higher time frame level on the previous Thursday and Friday, trading the weekly open on Monday and Tuesday is eligible. What do I mean by this? So let's say this is the weekly open for your current trading week, okay? This current trading week, this is the weekly open. If you look back and you see Thursday and Friday, okay, they already hit a higher time frame level, and you already see a market structure break. If Monday produces that failure swing, you can trade Monday, especially when it hits that intraday or intra-week drawn liquidity. You can trade that. But you have to see, okay, what happened the previous week? Did the previous week already trade off a higher time frame level? And if so, that means the weekly open, there's going to be excitement. Okay? Excitement on the weekly open. But if that's not the case, the previous Thursday or Friday, it didn't react to anything, there's no excitement in the market. Another situation is if price has reacted to a higher time frame level on Monday, trading the weekly open is eligible. So let's say Monday, this is the weekly open, and Monday hits a higher time frame level. London session or New York session, you typically want to be focusing on these ones. Trading the weekly open is eligible. Okay? But if we haven't hit a higher time frame, level on Monday, or we haven't hit a higher time frame level on the previous Friday or Thursday, don't rush to find a trade. Okay? Even if you say, okay, we can long into that level, just know that without the proper framework and context and narrative and understanding of if it's a high probability trade or low probability trade, just don't rush it. Market rewards patience. Okay, so we're back on this daily time frame. Order block, we have clean highs here. We can also mark these clean highs as targets. Fair value gap here. Here's an example of when trading the weekly open is eligible. This is the weekly open. Look back, Friday. What did Friday do? We're in a discount, and we've taken out daily low, and we broke market structure on a Monday. This is when we can trade Monday, because Friday reacted off a higher time frame level, daily low, with confirmation. So if we trade back into this fair value gap here, it's a buy. Okay, it's eligible. We can see movement early in the week, especially when there's clear narrative like this. I call this one on the YouTube channel. Here's another example. Weekly open. What happened on Friday? Well, Friday hit that higher time frame order block. Monday had that break in market structure. This is when we are allowed to trade early in the week, Monday and Tuesday. So if the previous week hit a higher time frame level and we open with excitement in the market, that is only when you're allowed to rush entries early in the market. But that's not the case if we go back to the economic calendar and we have news late in the week. Price is most likely going to want to hold for that. A poor trading habit is trading outside of kill zones. So similar to any real world business, the financial markets have their respected operating hours. It's like when you can't go to a bank at 2 in the morning, or you can't go to a bank at 1 a.m., right? The bank has their own operating hours. So trading is the exact same way. Assets that include the euro, the pound, move during London hours. Assets that include the Australian dollar, New Zealand dollar, and yen will be mostly trading during Asian hours. Okay, because that's when their currencies move. According to their time zone, that's when they're active, okay? So aspiring traders fall victim to thinking the markets move 24 hours a day, 5 days a week. Relating back to that hustle mindset, doing more, okay? No. Just because the market's always moving, okay, doesn't mean you can be always trading. There are business hours where you have to operate in, and that's actually an advantage for professional traders because we can schedule our week to these hours, which we'll talk about at the end of this video. So the truth is, the highest amount of market volume is generated within selected hours of a day, but candlesticks will print 24 hours a day regardless. Alright, so if you're looking at a 5-minute chart, there's always going to be 5-minute chart candles printing. Okay, but once we're in an important hour such as London session, these candlesticks suddenly have volume behind them, and they'll just have large expansions. Because the truth is, the highest amount of volume is generated within selected hours of a day. Okay, but once these hours are done, price is just going to go back with low volume candles. Trade during the highest amount of volume per day, okay, which is the kill zones. Since the highest amount of volume is generated during peak hours, Asian session for Asian pairs, London session, New York session for foreign currencies and dollar pairs, trade during these peak hours because important highs and lows will form within them. What are important highs and lows? Intermediate term highs, long-term highs, long-term lows, intermediate term lows. All these important highs and lows, they form within kill zones. And you could go through this yourself. If you want to see a fast response, you must execute your trade during these peak hours. Because if you're not executing within these peak hours, like I said here, you're going to be stuck in these ranges, and then your emotions are just going to build up to the point where you can't hold the trade anymore, and then that emotion just builds on top and on top. It just accumulates until you have so much emotions behind your trading, and the higher your emotions is behind your trading, the level of accuracy decreases. Okay, so all of this can be easily avoided if you just respected or you just avoid these poor trading habits. So this is an example. Look how trading setups, important highs are forming within kill zones. Movement is happening in kill zones. And then when the daily ranges close, 15, okay, that's when if the close happens, you can see how we're printing candles, right? Printing candles regardless, but it's not moving until we're in an important time. Here, you can see that, okay, price starts moving now. Displacement within the kill zone. Displacement within the kill zone. Important highs, setups, and movements. But then, if it closes, what happens? Printing candles regardless, okay, but no movement until Asia happens. Okay, forms important low. London, it forms important low, then high. movement happens. So trade specifically during these kill zones. Those are business operating hours. You don't want to go to the bank at 1 a.m. Otherwise, you're just going to be sitting there waiting for them to open. Okay, so you can see how important highs and lows form within these kill zones. Asia forms an important low. London kill zone forms an important high. New York kill zone takes out that important low. And what you see here, guys, we see a market maker sell model. Original consolidation, reaccumulation, smart money reversal, lower sell, displacement, distribution, 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 clears original consolidation. And we're done. So here is the market maker sell model. Okay. Asia forms an order block. Rebalance low. You can frame a support on that rebalance low. Accumulation. Institutional whole figure. We can sweep that for liquidity. 10 pips. Long kill zone. Print an order block. Lower sell. Displacement. Taking out low. Displacement. Optimal trade entry from this higher low. And since we're focusing on distribution now, resistance levels are going to hold. Support's going to break. Up candle, displace, resistance. Up candles, resistance. Clears the original low. Okay, so this is my favorite pattern, and we're going to talk way more about the market maker sell model in the Braveheart membership, because this is how I personally trade, and just a moment of appreciation for the amount of beauty in this pattern. So now let's talk about high performing trading habits. So the first one is framing your trades on the higher time frames. Okay, framing trades on the higher time frame levels. After following this video series, it must be clear at this point that the long-term perspective has the biggest influence on price action, because that's when the banks and financial institutions operate on. They operate on the higher time frames. So therefore, make it a habit to frame your trading ideas around the higher time frame level before you maneuver into the lower time frame. Trading based on the higher time frame level will also provide higher risk to reward setups. Why? Well, higher time frame levels is where the banks and financial institutions move price. That's where most of the volume is generated. So of course it's going to be bigger moves. With bigger moves, we can frame a higher risk reward setup. And if you focus solely on trading based on higher time frame levels, since there's higher risk reward setups, it's easy to find a 3-to-1 reward to risk setup. And with 3-to-1 reward to risk, you only need to be correct 30% of the time. Okay. What you need to do and make a habit of is develop the patience for price to trade at these areas. Because once a higher time frame level becomes activated, expect large range candles for multiple days due to the amount of volume being generated from it. So if this is a higher time frame level and you know it's going to trade towards that point, you're not looking for any trades here. Okay, you're waiting for this, a confirmation, then you can start participating in it. And guess what? The volume generated from this point is going to be shown with multiple days of selling. So you'll have a lot of opportunities to trade, because once we hit that higher time level, if it's a key one, that sets a trend, and that's when you'll see long-term moves happen for 10-20 days where you're just being a seller, but you gotta wait for it to hit that level first. You might have to wait 2 days, you might have to wait 3 days, but once you hit it and you have 20 days of just doing it, selling, then you're rewarded for your patience. So then it's your duty as a trader to navigate that order flow from the intermediate term and short-term perspectives once that higher time frame level becomes activated. 2. Choosing key levels that align with institutional order flow. After the higher time frame becomes active, that will become the parent order flow for all subordinate moves to come. You must select levels that align with that order flow. Once again, higher time frame level. That will become the source for subordinate moves to come. Select levels that align with that source. Frame your trades on intermediate term highs that align with that source. But first, wait for the confirmation that the level is active with the market structure break. So after we hit that level, do we have a significant market structure break? Second, wait for an intermediate term swing point that aligns with the parent order flow. Okay, so you're waiting for the intermediate swing point here and here that aligns with that high time frame level and the market structure break. Third, frame your trade idea on that intermediate term swing point. So let's say intermediate term high comes in. Frame your trade on that intermediate term high now. It could be a fair value gap. Then you could use an order block and then another fair value gap. But you're framing your trades on that intermediate term high because that intermediate term high is framed on that long term high. And you're doing all of this here on the short-term perspective, which is your entry time frame. Okay? So now let's talk about high performing habits from the short-term perspective. So this is what you do on the short-term perspective, all right? Trade based on confirmation, not anticipation. With the context and framework from the long-term perspective and intermediate-term perspective, execution from the short-term perspective should be the easiest part. Okay? These two perspectives do the anticipation. Long-term perspective does the anticipation. Okay? You're anticipating the market to trade high or low. Short-term perspective does the confirmation. Right? What does the confirmation look like on the short-term perspective? Well, if you see your entry pattern, okay? So the job of the short-term perspective is to find your entry pattern fractal within that color zone. That's it. You need to see it. You need to see the fair value gap. You need to see the MS shift, whatever your entry fractal pattern is. Mine is just a fair value gap. That's my entry pattern. If I see that within a kill zone, I'm taking that trade. That's all I need to see. But if you see that within the kill zone, especially with the context and framework from the long-term perspective and intermediate term perspective, okay, that is confirmation, right? Seeing the pattern on your chart. You're not anticipating it to happen at a level. You're not already taking a short order at it, okay? You have to see the pattern and then take action on it. And you must know exactly your entry pattern. Do you prefer a stop run into a fair value gap? Stick with that. Do you prefer order blocks with a fair value gap? Stick with that. Don't be a jack of all trades. Have your own entry pattern. Mine is just fair value gap. I'm comfortable trading order blocks, but I don't trade breakers. I don't trade mitigation blocks because that's not my entry pattern. My entry pattern is just a fair value gap with an order block. Those two levels I'm using. And if I see that with all the work I've done in long-term perspective and intermediate-term perspective, and I see that pattern in the short-term perspective, okay, I see it on the charts confirmed, I'm taking that. Alright? We do not gamble, we execute on solid setups. So know and study your entry pattern to the point where you understand and you trust its characteristics. So now let's talk about interbank routine and schedule. Every Sunday, you want to do the following. Step 1. Find the market narrative. Where does the market want to go? Or the higher time frames. This starts with a proper analysis of the long-term perspective and finding higher time frame levels. Start with the dollar, then make your way into pairs trade. We start with the dollar because dollar is the king currency that governs every market out there. So you don't start with the euro, you don't start with the pound, you don't start with the index futures, you start with the dollar, because that will tell you to be bearish on foreign currencies, bullish on foreign currencies, or bearish on index futures or bullish on index futures. The dollar will tell you that because the dollar governs all markets. So proper analysis on the long-term perspective for the dollar, find your higher time frame levels for the dollar, find a draw on liquidity for price, and wait for these higher time frame levels to be active before formulating any trade plan on the lower time frames. Step 2, create a framework. Okay? This is what you're doing on the intermediate term perspective. Study the economic calendar. Mark out the main news drivers for the dollar. Is the main news driver for the dollar early in the week? Is it on a Monday? Is it on a Tuesday? Is it on a Wednesday? Or is it all the way waiting on a Friday, like NFP? Alright? If news is late in the week, anticipate midweek consolidation, an expansion Wednesday, New York session, Thursday and Friday. So midweek consolidation is consolidating and it's waiting for that news late in the week to then do its job in business to trade lower. But if the news is early in the week, anticipate for weekly highs and lows to fall Monday, Tuesday, and Wednesday. Monday might range, Tuesday forms a high of the week, then a lower. Or maybe there's excitement on the opening, you'll see Monday form a further swing up, and then trade lower on Monday, New York session, Tuesday, and Wednesday. Okay? But in this case, we're studying the economic calendar. We're trying to picture and manifest what that weekly range is most likely going to do. Okay, is that weekly high going to form early in the week or late in the week based on the economic calendar? Okay, so this is the first clue for us. It's always going to be the first clue for us. Next, with the framework, right? So the economic calendar is going to give you an idea of when weekly highs and lows are going to form within that weekly range. Now it's time to find where is it going to do that. So identify levels that align with institutional order flow from the intermediate term perspective. Mark out market structure breaks, if any. Mark out intermediate term swing points, if any. Mark out where prices were in a premium or discount. Mark out potential intermediate term swing points, if any. Okay, so step 1 was higher time frame level. Okay, and then we're waiting for, okay, based on the economic calendar, when can the weekly highs and lows form? And then we want to look in price action to tell us, okay, where can it form? So on the intermediate term perspective, mark out if there's any market structure breaks. Okay, or maybe there's already an intermediate term swing point, mark that out. Okay, or maybe price has to trade back into a premium or discount, mark out that range. Okay, or mark out any potential intermediate swing points already. Okay, do we have a fair value gap period that price can potentially form an intermediate term swing point? Or did we already take out a high and we're going to expect a classical intermediate term high? right? Mark out all of these potential scenarios, okay? Because that's where, where we're gonna find weekly highs and lows, the format. Then we want to blend that with the news events. So that's time and price. So ask yourself the following: Monday through Friday, what news events can cause volatility to activate these levels? Okay, so let's take scenario 4. All right, mark out potential area where price could form an intermediate swing point. So let's say price already hit a long-term level, broke market structure, and then there's a fair value gap here that has been untested. Okay, it's fresh. Let's say we have news here on a Tuesday. Okay, ask yourself following: Monday through Friday, what news events can cause volatilities to activate these levels? So if there's news on Tuesday, okay, will that form an intermediate term high to bring price lower, right? Or will price already test this, and then on Tuesday, the volatility is provided to bring it lower when the news happens? Okay, you're blending the news events with the price levels, and that's how you create framework. Scheduling when to be active. So after building narrative and framework, you should see clearly where the price will want to trade towards next. It's either waiting to test a higher time frame level, okay, which is untested, or retracing within a daily range on the intermediate term perspective. Okay, so it's either waiting to hit a higher time frame level, or it's already hit the higher time frame level and now it's retracing within that parent price range, or it's waiting to hit that higher time frame level. Okay, so price is here is waiting to hit that. You now have a plan for where price and when price will print important highs and lows. Is price going to print an important high here? Is price going to print an important high here because of a fair value gap? Okay. You know where and when these are going to happen. Kill zones, news events, price levels. It's your job to be active from the short-term perspective to participate on these entries. So schedule those days in specific hours and only be trading then. So you know basically economic calendar when you should be active. You're looking, okay, what kill zone is that news event in? And then on that day, only then are you active. You're not going to be in front of the charts when price hasn't even tested this point here yet, because you're just going to waste your time. Wait for prices to hit this, then wait for a kill zone and a news event to look for action. Okay, and that's how I schedule my week. I look at the economic calendar. I say, okay, do we have news late in the week or early in the week? And if it's late in the week, I just take Mondays and Tuesdays and Wednesdays off, and that's how I can find the time to make these types of videos. If there's news early in the week, then I trade Mondays, Tuesdays, and Wednesdays, and then I take Thursdays and Fridays off because price has already moved early in the week. So I schedule my trading hours based on the economic calendar and what's seen in price action. So here's the action step. Create your interbank trading routine and schedule and use it every Sunday. So create your own routine every Sunday. Go through all these 3 steps I just mentioned. Start with the dollar index and make your way into the pairs you trade. And then create a schedule around the economic calendar. When do you want to see price hit these levels? Kill zones. But specifically, which kill zones? kill zones that include news events, because those are when markets are going to form important highs and lows. Right? Then on Sunday, once you build your schedule, Monday through Friday, you'll know exactly when price is going to move, and you're not going to waste any precious time on the markets just staring at the screen and price doing nothing. Ultimately, you can use that valuable time to do something else. Go backtest, or go study, or go spend time with your family. This is how you save time and be in front of the charts when it's actually important. But not only will this improve your trading significantly, it will also prevent you from trading low probability trades. Because high probability trading is when the markets are actually supposed to move. And if the markets are not going to move because banks are not pushing price anywhere, then you're just going to frustrate yourself, which could lead to a downward spiral and more bad trades and more emotional trading. So if you skip this step, just know that you might face emotional trading for the week ahead.